the only time I get attention around here. Good morning. Welcome to the January 2024 Consensus Revenue Estimating Conference. I don't know. Can you all hear me over there? Am I good, Dave? I'm Mary Ann Cleary, Director of the House Fiscal Agency and the conference chair this year. With me today is State Treasurer Rachel Eubanks, Senate Fiscal Agency Director Catherine Summers, and our State Budget Director Jen Flood. Welcome. At this time, does anyone have any opening remarks? Nope. Okay, great. So I'd like to remind everyone who's either in the audience or actually watching on House and Senate TV, all of the presentation materials are on the House Fiscal Agency and the Senate Fiscal Agency website at this time, and you can get that information there. This meeting does fulfill the statutory requirement under sections 367A and 367F of the Management and Budget Act, specifically regarding the Revenue Estimating Conference. So with that, Dave, do you need to do something? I think there's just a little bit of a technical thing going on. I don't think they can see it on the House TV, but right here, I think they're going to come do that. With that, I'm going to just announce our next speakers. Our first two speakers, I should say, this morning are no strangers to the Revenue Conference, Danielle Manikoff and Gabe Yerlich from the Research Seminar in Quantitative Economics, or simply RSQE. Danielle is an economic forecaster at the University of Michigan. He is the lead research area specialist at RSQE. His main areas of expertise are macroeconomics, monetary economics, and applied econometrics. Danielle received his PhD in economics at the University of Minnesota and holds a Master's of Science degree in applied mathematics and physics from the Moscow Institute of Physics and Technology. With him is Gabe Yerlich. He's an economic forecaster also at the University of Michigan and also the director of RSQE. He received his PhD in economics from the University of Michigan. Gabe oversees the RSQE forecasts for the U.S. and Michigan economies, and he presents regularly to the Michigan legislature and the governor on Michigan's fiscal and economic prospects. So when these two fine gentlemen here are finished, we will start that presentation. Thank you. Good morning.
Great. Thank you for the introduction. It's always a great honor to be here. And I'm hearing that Jimmy Stansel might be retiring. This might be his last event in official capacity, so I want to thank him for more than a decade of fun we had together. All right. So I can repeat the thank you, but I'm guessing Jim has heard it. All right. So, and on the purpose of trying to keep us on schedule and maybe hopefully getting out of here before the blizzard starts, I'm just going to try to be concise, but it's probably not going to work. So let me jump into where we are in the state of the economy right now, and I'm going to start as usual with a picture that shows the recent dynamics of real GDP. On this chart, I have a solid black line, which shows the quarterly annualized pace of real GDP growth. I also have colored stacked bars that show contributions of different key sectors to the headline number. What I want to focus right now, however, is on the dashed line, which is the growth contribution of domestic final sales, that is GDP, without two volatile components of inventory contribution and net exports. And we think the dashed line is a better metric of where the economic momentum is. And you can see that the dashed line averaged about 3.2% pace over the first 3 quarters of 2023, which is a market acceleration relative to where we saw it during 2022. Few words on the expected growth, just to front run our forecast. We do expect growth to slow down in the next several quarters. And the major driver of the slowdown is going to be consumption, which is we expect to finally take a hit from higher interest rates, but also from slowing of payroll. So basically slowing wage growth and slowing payroll job count growth. We also expect the inventory accumulation, that is the green bar on this picture, to trend towards zero, which it usually, well, averages to. And we expect government spending growth to slow, the red bar on the chart. It's been largely driven by strong job gains at the local government level, and I'll talk about that again a little bit later. Now I want to switch gears and talk about the biggest story in the economy over the past couple of months, which is the rapid and somewhat unexpected disinflation that surprised many economists, us included. So what I'm showing you here is the recent trend in core inflation, that is inflation abstracting from prices of food and energy, which are typically quite volatile. So I have two measures here. One of them is CPI, core inflation, and I'm showing you the recent 3 months averaged and then converted to annual rate. And the blue line is the comparable metric on the personal consumption expenditures deflator. You can see that both metrics decelerated quite significantly in recent months. The Fed is paying more attention to the blue line, which is their preferred metric overall, and they're probably looking at core as a signal of what's going to happen to overall inflation over the next year or two. So this deceleration came on quite dramatically, I would say. So I want to look at a little bit of extra detail of what has happened, what has transpired. So on the there are different subcomponents of personal consumption expenditures deflator. There are goods, and the prices of goods had been pretty much back to pre-COVID levels for quite some time now. So all the action is in the services. So here I'm showing you a slice of service consumption that abstracts away from housing, which I'm going to show next, and energy, which is quite volatile. And this represents about 50% of overall consumption expenditures in the economy. And here I'm showing you a few things. So solid blue and maize lines are 3 months annualized pace of price index for this particular slice of service consumption. And the dotted lines, or like broken lines, are year-over-year readings that correspond to those. And the two lines are actually two different vintages. So the blue line is how this metric looked at the end of October when we did our major conference. And the yellow line is how it looks right now as of the latest data. So here you can see two things have happened. First, we got some pretty significant revisions for the third quarter readings because the yellow lines is below the blue line where we have readings for both. And then we got followed up with two further disinflationary readings on the yellow line, which are below 3%. So we had a quite basically combination of disinflation that continued, but also some previously revised data that got a lot closer to what the Fed wants it to be. Now, we are about 3% pace. I'm going to argue that this is probably consistent with Fed taking a victory lap. 3% is a little bit higher than what it's been before COVID, but remember I abstracted away from housing. I'm going to show you what's happening or what's about to happen in housing next. So here I have the personal consumption expenditure housing deflator in maize, or yellow, whichever you prefer. And it's been slowing for a while, but there are two other metrics which basically tell us that the slowdown of the yellow line is likely to continue. So the other two metrics in green and blue lines are measures of new tenant rents, while the yellow line is basically the average rent in the economy. So everybody who's staying put and staying in their own home and pays equivalent rent. So the other two metrics are the Zillow Observed Rent Index, and the other one is an experimental series that the Bureau of Labor Statistics just started publishing. They both show that new tenant rents inflation year over year peaked sometime early in 2012 and basically came down to pre-COVID levels recently. And data and research shows that there's probably like 3 or 4 quarter lag between the behavior of new rents and average rents. So basically you can see there's probably at least several more months that we can expect the yellow line to keep declining. So basically the non-housing part, if it stays around 3%, and this part keeps declining, we expect basically to be right around 2% overall PCE. So Unless inflation reaccelerates, it's probably job well done for the Fed. Might have been some other things that have helped, but they'll certainly take the credit. So let me talk about what transpired. So this is like relatively recent development. So we got those revisions sometime in November and December, and we got 2 new readings for November and December. So over the past couple of months, basically there's been a significant repricing of what the Fed is expected to do, and that led to significant changes in longer-term interest rates, which I have on this chart. And what I want you to focus on is really just the decline in the last couple of months. So we've seen most longer-term yields come down a full percentage point. They're still higher than they've been over the past decade after the Great Recession, but they are quite a bit lower than they were even this fall. What that did is also important for what I'm going to talk about later, which is mortgage rates. Mortgage rates almost approached 8% for 30-year fixed mortgage in late October. They've come down to about 6.7% as of the latest reading. So that should help, not immediately, but eventually. So the point here is that inflation is suddenly pretty close to trend, so the Fed can now afford to switch basically into full employment preservation mode. And we think that means a bunch of cuts in the Fed funds rate going forward, but it also means that the Fed is going to pay more attention to the labor market. So let's focus on what's happening in the labor market quickly. So first, I'm showing you the monthly payroll job gains, and they have been slowing, but the pace is still fairly respectable if you compare it to what we've been seeing after the Great Recession. So the latest reading of 216,000 jobs for December, I wouldn't read it too much because over the past year, a lot of initial readings were revised downward significantly, but it's probably still going to be fairly respectable. So the 6 months average of recent gains is just under 200,000 jobs per month, which is fairly decent. If you focus on the latest dip, we had a decline in October, which was driven by the UAW strike. We had some rebound in November and maybe a little bit of rebound in December. Job gains are a little bit more concentrated than they were during 2012, but they're still fairly broad. We've been getting some significant help from state and local government, and a lot of private sector job gains came from healthcare, social services, and leisure. But a lot of sectors are still growing. So we're not at the level where like 1 or 2 sectors are driving everything. We don't expect a dramatic slowing of job gains anytime soon, looking at high frequency indicators, which I'm not going to chart, but unemployment claims are still pretty low, and things like WARN Act notices are still fairly low as well. Another high-profile metric is what's happening with job openings. Here I have 2 metrics. One is the official job openings and labor turnover survey, and that one is in blue. And the other metric is the number of job openings on the Indeed.com job aggregator site. Both of them are trending down from a very, very high level, and both metrics are above what they were at the beginning of 2020, which was a pretty tight labor market as well. So the labor market is softening, but it's still pretty tight. Now I'm going to throw a little bit of a turtle in the punch bowl. There are some weaknesses out there. There is a section of employment that tends to, at least over the past couple of recessions, tended to be a leading indicator. And this is employment in temporary help services. So basically, these are your temp agency employment, but also people hired for specific projects. So in the recession of 2001 and 2008, this metric, which I'm showing you in the year-over-year change in May's, basically started getting below zero several months before the broader employment, which I show you in this chart in blue, turned down. So as you can see, the yellow line has been significantly negative for the past year or so, which is alarming. It basically says there are pockets of weakness out there. And it says that even though we don't expect a recession, the chances of recession are still non-trivial. So something to watch for. But in general theme is that the labor market is softening. There are some parts of it that are softening faster than others. Let me talk about a few more sectors of the economy, what's going on. First, I want to spend a few minutes on residential housing. Here I have a little bit of a seesaw pattern on one of the charts. So I'm charting two things. The blue line is the National Association of Home Builders Housing Market Index, and it's basically a sentiment index, and readings over 50 is when things are getting better, readings below 50 when the market is shrinking. And the other metric is the Mortgage Banker Association loan applications for purchase. So we had mortgage rates shoot up during 2022 and then sort of stabilize early in 2023. So while mortgage rates were shooting up, both yellow and blue lines basically cratered. But then early in 2023, in the first half, the blue line basically started improving and increased above 50. And the yellow line, if you squint, maybe stabilized a little bit. Then in the second half of 2023, with mortgage rates again pushing up toward the 7%, towards the 8%, we had the home builder confidence collapse again, and we had further declines in mortgage applications. Now, with mortgages suddenly jumping down to like 6.5% over the last, say, month or so, we've seen a little bit of a blip on the blue line, but we expect to see more of it because 6.6 is a lot better than 8% mortgage. And we've seen a little bit of uptick in more loan applications. We're hoping to see more. And in general, we are somewhat optimistic on the residential housing for the following reason. So mortgage rates at 6.6 is good news relative to 8%, but for a lot of people who are sitting on their 3 to 4% mortgages, it's still a lot to go and buy a new house. So they're going to be sitting on their existing home and not listing it for sale. So the existing home market is going to stay tight, and it's probably driving price increases. But the new construction has this extra margin to adjust pricing. They can build a little bit smaller homes. They can use a little bit cheaper materials. So they have some margin where they can tweak pricing. So they'll probably try to get a little bit of market share. So we think residential housing can be growing. So let me show you what's happening on the indices for supply managers, and there is some concerning developments here as well. Here I'm showing you two things. So the Institute for Supply Management asks basically purchasing managers about what's happening in their business. It's a diffusion index again. Readings over 50 indicate things are growing. Readings below 50 are saying things are shrinking. Manufacturing, which is in yellow, has been shrinking for about a year, and for some time we thought it was about to turn around, but apparently not yet. The more concerning development is that the blue line, which is the index for services, which is a lot larger share of the economy, seems to be scraping along the 50, which is good for us making a forecast for a slowdown, but you would hope that this metric stays above 50 so that we can keep growing. And finally, one of the high frequency charts is what's happening with light vehicle sales and assemblies. So here I'm showing you total light vehicle sales in yellow, and it uses the left-hand axis, and I'm showing you domestic light vehicle assembly pace in blue in the right-hand axis. Both are in million units of annualized pace. So domestic production in blue, you can see that it ran roughly at its 2018 pace, which was pretty good, in the summer months before the UAW strike. Then during the strike, the output, I'm not going to say cratered, but came down to some extent and only rebounded partially in November. However, looking at production plans of manufacturers, we expect the blue line fully to ramp up back to the levels we saw this summer. On the sales side, which is the yellow line, we reached 16 million in June, but since then we've been averaging about 15.5 to 15.6. So we think interest rates were biting, and maybe the pent-up demand was running out. We are hoping that this metric will keep growing, largely because we expect interest rates for car loans to come down. They have not yet. So mortgage rates come down significantly since early December. Vehicle loan rates have not. So we're hoping they will. So let me talk you through about our policy assumptions very briefly. So as I said, the Fed is pretty much close to where they want to be, unless inflation reaccelerates, which is a possibility, which we don't have in our forecast. The Fed basically can focus on avoiding a recession. So we project that means that the Fed is going to be gradually cutting rates over the next couple of years. They'll start this spring and deliver about 2 percentage points worth of cuts through the end of 2026, which is a little bit more not what the markets expect. Markets expect a lot more cuts. On the fiscal side, we expect the divided government to run beyond the 2024 election. There is some uncertainty there. I'm going to list it in the risk slide. As a result, we expect only modest spending restraint, basically some modest spending growth for the next 3 fiscal years. And the overall deficit is probably going to stay around 6% as interest expenses continue to grow because interest rates are still much higher than they were over the prior decade. So let me jump into the forecast numbers. In general, I still want to say that uncertainty is quite elevated. So what we have is fairly optimistic, but chances of a recession actually happening are still non-trivial. So with this, I'm going to give you our outlook. So the black line is the history and our forecast of economic growth for real GDP on quarterly basis, annualized. We show some slowing in the near term and basically then back to about 2.1% growth. The slowdown largely comes from consumption, as I mentioned earlier, and some of it is also from inventory accumulation slowing down and government spending contributing less. I've thrown in the latest Bloomberg consensus median numbers in green, just to show that we are a little bit on the optimistic side. However, that December survey was probably compiled before the December FOMC meeting, which basically was a large, longer-term interest rate repricing event. So I would imagine many of the people who are on the survey in December will be revising their forecasts a little bit up in the upcoming survey. So the yellow bars on this chart show annual averages, and we have about 2.4% for this year, slowing down to only 1.9% next year, despite the quarterly path averaging about 1.3% pace for the first 3 quarters. And that's basically because we got fairly strong growth to finish out 2023. That's how annual average math works in this case. And then we get back to about 2.1, 2.2% growth in 2025 and 2026. Next, I'm going to give you our outline for payroll for the jobs market. So here I'm showing you payroll employment growth. And the story is about the same. We see a gradual slowing, and the bottom is around 60,000 jobs per month in the second half of 2024. And then we expect job gains to ramp up, but not dramatically. So we expect only about 120,000 jobs per month range in 2025 and 2026 for 2 reasons. First, our population is not growing that strongly, so it's basically going to be a challenge to finding people to hire. Second, a few years of very, very tight labor market are probably going to be driving some productivity improvement, which will mean that you will need a little bit fewer people for the same amount of work. So the difference between the blue line, which is the total job gains, and the yellow line, which is the private job gains, is naturally the government. And you can see the difference has been significant lately. As I mentioned, that's mostly coming from local governments, and it's largely catching up to pre-COVID level of employment, which hasn't happened yet. But it probably will, and at that point, job gains will probably slow down. So we expect the gap between the blue and yellow lines to close over 2024. And that, incidentally, will slow down the contribution of the government expenditures to GDP growth. Next, I'm showing you the picture of the unemployment rate projections and the participation rate. The participation rate in blue is relatively flat, and it's basically 2 opposing forces are going to balance each other out. It's the ongoing retirement of the baby boomers, which is driving this down, but also the labor market will stay relatively tight, which is going to draw some people back into the labor force. The unemployment rate rises just a little bit from about 3.7% right now to about 4.2% by the end of 2024, and 4.2% is still pretty tight labor market. And then at that point, we expect the Fed to be cutting rates and longer-term rates to come down some more and help the economy to some extent. So at that point, we expect the unemployment rate to start edging down, dipping below 4% again by the second half of 2026. On the inflation front, this shows you the year-over-year headline CPI in blue and core CPI in yellow. So year-over-year readings sort of hide that a lot of deceleration has already happened in the past several months. So if we stay at the recent level, basically we're going to transition to about 2.5% inflation year-over-year by the end of 2024. And we roughly stay there. CPI inflation typically runs a little bit ahead of the Fed's target, which is the PCE inflation, which we expect to be around 2.1%, which is pretty close to target. Our projections for interest rates are here. The yellow line is the 10-year rate. The green line is the 3-month Treasury bill. And the blue line is the conventional 30-year mortgage rate. So the green line basically follows our Fed funds rate path and keeps declining throughout the forecast. The 10-year rate declines slower, largely because we expect there to be a significant term premium. At least we expect it to grow. The blue line is what's important for the housing market, and there are two things here. So mortgages historically traded as about 1.5% above the 10-year Treasury. Over the past years, the spread between the mortgage rate and the 10-year Treasury blew up to about 3%. So that's basically reflecting some kind of risk aversion in the economy and uncertainty about where the interest rates were about to go. Now that we're in a part where it's reasonably expected that the long-term rates are going to start coming down, that premium is probably going to shrink, and we expect it to start declining to about 2.7% in this current quarter, then to shrink to 2% by the end of this year, and then taper off to about 1.5% by the end of 2026. So the yellow line is declining, and the spread between the yellow and the blue line is going to be declining. So we expect the mortgage rates to dip below 6% by the end of this quarter, and then to decline to about 5.5% by the end of 2026. So that's going to help with housing affordability, which I'm going to spend just a second on. So we have a mortgage payment as a share of wage income chart in blue. It went pretty high, topping the top of the housing bubble in the mid-2000s. We expect it to improve, but not all the way to where it's been over 2010. So basically, existing housing is going to remain quite unaffordable by the standards of 2010s. So that's going to help with housing starts because, like I said, new construction has a little bit of a margin of adjustment. They will be building a little bit smaller houses with a little bit cheaper materials. So they're going to have some market niche to fill in. So here I have single-family home starts in yellow. So we expect gradual growth there. The green line is the multifamily housing, which has stepped down this year, largely because they overbuilt during COVID. So a lot of new inventory came onto market, and there's currently an elevated vacancy rate. So we expect the rental market to be a little bit lax, but given that we don't expect any recession and we expect fairly brisk growth going forward, we think that there's going to be demand for rentals. So the green line is going to keep growing. The blue line is just the sum of the two. And I'm going to list the risks without going into too much detail. So a lot of data we're looking at is subject to revision. So economic momentum that we think is present could evaporate. Inflation is uncertain. It could ramp up, which will change monetary policy and everything that goes along. Commercial real estate is the big wild card. Depending on how elections turned out, fiscal trajectory could be very, very different. Geopolitical situation is very uncertain and could be a source of additional uncertainty. And last but not least, population growth is the #1 driver of everything in the economy. I know we are concerned about this in Michigan, but it's much easier to attract population when the overall population in the country is growing. When it's not growing, it's just reshuffling population between states, which gets much harder. So I'm going to turn it over to Gabe. Thank you.
Oh, great. Okay. Well, thanks, Daniil, and thanks very much, to our hosts for having us here today. I always say it's an honor to be invited to participate in this conference. I, just want to tell you we really mean that. It's always, it's a highlight, especially in a dreary month. It's fun to be here. So thanks. I'm excited to share our outlook for Michigan's economy over the next 3 years with you. But before I show you our forecast, I wanted to look backwards very briefly to talk about the strike in the auto industry last fall, because I do think it has important lessons for how we should think about the state economy and the revenue picture, especially in the future, if we get into a similar situation several years from now. So just to review what happened in the so-called stand-up strike last fall, the United Auto Workers struck against one assembly plant at each of the Detroit 3 automakers on September 15th last year, and then added strike targets gradually as the negotiations went on. And, we just got the timeline very briefly here. You can see, how many workers were striking at each of the plants, as new strike targets were announced. The UAW reached tentative agreements with each of the Detroit 3 automakers in late October of last year. So the final full week of strike impacts was the week beginning on Monday, October 23rd, and that was the 6th week of the strike. We estimate that nearly 51,000 UAW workers across the Detroit 3 automakers and across the country were ultimately involved in the strike, with about 17,500 of those workers at facilities in Michigan. So just over a third of the total striking workers were here in Michigan. This figure shows our estimates of the strike's impact on national employment, and Daniil mentioned, that there was an impact during the strike. So over the 6 full weeks of the strike. The blue portion of each bar shows the number of workers on strike each week, while the yellow portion shows our estimate of the spillover job losses, which include layoffs at the big 3 automakers, or the Detroit 3 automakers, separate from the striking workers. So if you'll recall, some workers were laid off because, plants that were shut down by the strike then, spilled over into other production. Layoffs elsewhere along the automotive supply chain, so at suppliers, essentially, and then other spillovers in local communities as well. And what you can see is that the strike's impact on national employment grew steadily each week of the strike, with the impact starting off pretty modest before accelerating into the final weeks. The estimated impacts for the 4th week of the strike correspond to the survey period for the October 2023 October payroll jobs report. And for that week, we estimate a total national job loss of just about 70,000 jobs, 69,500 jobs, including 27,400 striking workers and just over 42,000 spin-off job losses or spillover job losses across the economy. And you can see by the 6th week of the strike, that had grown significantly. We estimate that the strike reduced total U.S. employment by over 140,000 jobs that week, including about 47,300 striking workers and almost 94,000 spillover jobs. This slide shows you our estimate for the state of Michigan. And again, you can see, the pattern looks similar. The numbers are different, but the pattern looks similar to the national impacts. By the 4th week of the strike, which corresponds to the, the jobs report for October, Michigan is estimated to have lost about 20,000 jobs, which consists of 11,400 striking workers and about 8,600 spillover job losses. And that comes to nearly 30% of the national strike-related job losses through week 4. And we estimate that job losses in Michigan grew to just over 37,000 by week 6. So just to show you those numbers in tabular form, I've got the numbers here on this table. And we've also estimated the effects on state non-business tax revenue in Michigan. So over the course of the 6 weeks of the strike, we estimate that it reduced personal income in the United States by nearly $500 million. Nearly a quarter of those losses were in Michigan. We estimate that the state lost about $114 million of personal income due to the strike. When we estimate the effects on state tax revenue, that really translates into a loss of about $7 million. One caveat to those estimates is that we did not include the strike's impacts on business tax revenue for various reasons that I won't get into now. And I also just want to caution that the lost profits for the automakers, we know the strike was very expensive, are not counted in personal income and they're not included in our estimates here. But, the reason that I wanted to take a look back at the strike's impacts is obviously, it was a big story this past fall. It does affect some of the numbers I'll show you, in our forecast. But, the big lesson is that at the end of the day, the strike's impacts on state tax revenue were pretty modest relative to the state budget. And I think that's something that we should keep in mind in Michigan, if this situation does arise again in the future. And, the one caveat that my team insisted that I mention, after I went through my remarks and people said, no, you have to mention, we do think that the effects of the strike would have continued to grow. So just, coming back, you can see that the effects were growing over time. If the strike had gone on longer, we expect that would have continued for at least a while longer, that the effects would have continued to grow. So in that sense, Michigan kind of got lucky that the strike ended, in a relatively timely fashion. Okay, so with that, I'll switch gears, and I'll show you where Michigan's economy stands in the latest data. This slide shows you 2 different measures of state employment through the most recent data point that we have, which for the state of Michigan is currently November of 2023. So Daniil was able to show you data for 1 extra month. For December, we don't have that for the state yet. And we've indexed both series to be equal to a value of 100 as of February 2020, so just before the pandemic. The first measure of employment is in the blue line, and we call it payroll employment or wage and salary employment, and it measures employment at establishments for a paycheck. So it does not include self-employment. Last summer, it was looking like Michigan would get back to the pre-pandemic level of payroll employment at any month. We were kind of waiting. We kept thinking, okay, we're going to get there. In fact, payroll employment dipped in September. And then, obviously, the UAW strike affected the numbers in October. As of November, Michigan's payroll jobs count was about 0.5% lower than it was just before the pandemic. And again, you can see that in the blue line. The yellow line is what we call household employment. It comes from a different survey, a survey of households. And it's the count of employed Michigan residents. There are various differences between the blue line and the yellow line. One thing is that the blue line includes the self-employed. Michigan surpassed the pre-pandemic household employment level in July of last year, July 2023. And by November, household employment in Michigan stood about 1.4% above the pre-pandemic level. So just depending how you measure it, employment in Michigan has either recovered already from the pandemic or we're getting close. This slide shows you labor demand as measured by total job postings on the job site Indeed, and Daniil showed you some of this data on a previous slide. Something that Daniil's data showed is that the data from Indeed tends to track the government statistics pretty well. One reason that I show the Indeed numbers is that I can show you more granularity for different regions of Michigan that you don't get in the official statistics. And it's also a little bit more timely. And again, I've indexed these numbers to have a value of 100 in February 2020. And of course, I know the story is familiar by now, but obviously employment demand or job postings fell off very sharply at the start of the pandemic, but then it absolutely exploded coming out of the pandemic, with all of the stimulus in the economy. And you can see we kind of got to a peak in late 2021. Job openings have been cooling off pretty steadily since the end of 2021, though. Nationally and statewide here in Michigan, job openings are about a quarter higher than they were at the start of 2020. And you can see in the green line, that's for the Grand Rapids metro area. Labor demand is a little bit stronger relative to just before the pandemic than it is statewide. In the Detroit area, job openings are a little bit weaker than statewide, compared to just before the pandemic. But still, in all of these markets, job openings are still well above the pre-COVID level. So I think that's important to keep in mind. And this slide shows you local inflation as measured by the Detroit CPI. Daniil mentioned that we've seen a lot of progress on inflation. I have to be the bearer of bad news. We haven't seen as much progress in Detroit, actually. The all items or headline measure of inflation is in the blue line. And again, the core measure, which strips out volatile food and energy prices, is in the maize line. Both, as Daniil showed you, both headline and core inflation are finally slowing down in the recent data, but the progress has been choppy. Still, the slowdown has been a big relief to us because we've been forecasting it for a while now. We've been coming to events like this and we've been telling people, listen, it's going to happen. Inflation is going to cool off. It's nice to be able to actually show you that it is happening now. The local headline inflation rate finished 2023 at 4.4% year over year. So again, that's the blue line. That was more than a percentage point faster than the national rate. And the local core CPI inflation rate finished at 5.5% in December, year over year, which again is faster than the national rate, about 1.6 percentage points. So we are seeing progress on inflation. It's been a little bit slower here in Michigan than nationally. And so with that, I'll turn to our forecast for the Michigan economy, starting with light vehicle sales. National light vehicle sales are in the yellow line at the top of the graph, and they finished just shy of 15.5 million units in 2023, which was a very welcome increase from about 13.8 million unit sales in 2022. And we're projecting national sales to climb to about 16 million units this year, and then hover around the low to mid 16 million unit range in 2025 and 2026. One thing to point out is that we don't expect unit sales to get back to the pace we were seeing before the pandemic of over 17 million units per year in our forecast. And then now, turning my attention to the blue line, which shows you Detroit 3 sales, Our forecast for the Detroit 3 sales pace is really for it to inch up a little bit. If you squint, it does inch up a little, but not a lot. We had 5.6 million unit sales last year. We're forecasting 5.7 million this year, and then bouncing around that level in 2025 and 2026. Again, that wouldn't get us back to where we were before the pandemic. And the reality is a combination of high prices. If you've gone shopping for a car, you'll know it's quite the eye opener, and high interest rates. Daniil showed you we are seeing interest rates coming down, but they're still substantially elevated from where they were a couple of years ago. And both of those factors are likely to weigh on sales volumes, both for the Detroit 3 and for the total market over the next few years. This slide shows you our forecast for the level of payroll employment in Michigan through 2026, along with the history going back to the start of the 2000s. And I pointed out earlier that Michigan is close, but not quite there in terms of recovering all of the payroll jobs that it lost at the start of the pandemic. The final complete data point on this graph is where the dashed line is. That's the third quarter of 2023. We currently have 2 months of data for the fourth quarter, which is, I don't know how effective this will be, but that's where the blip is there. If you see just, it's not going to show up on the screen, but just after the dashed line, you can see the dip there. That reflects 2 months of data that we have for the quarter, so it's not just us spitballing, but we don't have the final the month yet for the state. That partly reflects the UAW strike last fall, but jobs declined in the month before the strike as well, but before we think that there should have been an impact from the strike. So it's just something to keep an eye on. On a quarterly basis, we expect to get back above the pre-pandemic job count in the second quarter of this year. So basically by the midway point of the year, we hope to get back above where we were before the pandemic. And then you can see we're forecasting job growth to continue from there through 2026, but at a substantially slower pace than what we saw coming out of the pandemic, right? And as Daniil mentioned, that's to be expected as the state really makes a full recovery from the pandemic. Looking at annual averages, we estimate that Michigan added about 63,000 jobs last year. So in 2023, we're forecasting job gains to slow down to 27,000 this year, before picking up to 51,000 next year in 2025 as the national economy gains steam. And then growth slows back down to 23,000 job gains in 2026 as the state really runs up against constraints in the labor market and on labor supply. By the end of our forecast, statewide employment climbs to nearly 90,000 jobs above where we were before the pandemic. That would still be about 160,000 jobs below Michigan's all-time employment peak from the second quarter of 2000, though. So on this slide, we've divided Michigan's industries into our 3 standard groups, which are blue-collar industries in the blue line, higher education services industries in the yellow line, and lower education services industries in the green line. And just as a reminder, the distinction between the higher education and lower education services industries is that the higher education services industries typically require a bachelor's degree or more education. We've plotted our employment forecast for each group relative to the first quarter of 2020, again, indexed to a value of 100 in that first quarter. Michigan's blue-collar industries really initially led the recovery from the pandemic, and that was a theme that we hit a lot in previous presentations. We do estimate that they took a step backwards in the fourth quarter of last year amid the UAW strike. We do expect growth in these industries to resume going forward, but again, at a more moderate pace than we've seen recently. And I'm sure people have seen the recent announcements of job cuts at both GM and Stellantis. Obviously the exact number of those job cuts remains unknown, but just the reality is that high interest rates are going to be a challenge for Michigan's manufacturing sector in the short run. And Michigan's construction sector has also been losing jobs over the past few months amid high mortgage rates. Taken together, Michigan's blue-collar industries add an average of about 8,000 jobs per year over the next 3 years, which is a growth rate of about 0.7% per year. So that's growth, but it's just not what we saw coming out of the pandemic. We've got better news for Michigan's higher education services industries. We expect their growth pace to slow down from what we've seen over the past few years, but not nearly as sharply as we've seen for the blue-collar industries. And part of the reason for that is that they weren't growing as quickly. We're projecting average job gains of about 19,000 per year over the next 3 years in these industries, which would be a growth of about 1% per year. As Daniil mentioned, mortgage rates are falling in our forecast, and the state's finance industry should get some relief from that decline in mortgage rates, while the health and government sectors also add jobs at a pretty solid clip in our forecast. And then I guess I would characterize the news as mixed for Michigan's lower education services industries, which again are in the green line. They've actually been losing jobs. I mean, I want to be upfront. They've been losing jobs since the middle of 2023. With notable job losses in leisure and hospitality and administrative support and waste management. And that includes temporary help, which, Daniil mentioned can be a leading indicator of employment in his slides. We expect a flat patch for these industries through the first half of this year. Again, reflecting, a soft patch for national growth that we're forecasting. But we are projecting, growth to begin to return late in 2024. And you can see that in the forecast. Job gains average about 12,500 per year in 2025 and 2026, although they lose on an annual average basis, they lose about 6,000 jobs this year. Our projected job growth rate for the lower education services industries comes to an average of about 0.5% per year from 2024 through 2026. And one thing you can see is that even by the end of 2026, we don't expect Michigan's lower education services industries to get back to their pre-pandemic employment level. One drag on growth in these industries is in the retail trade sector, as obviously the shift to online commerce continues. This slide shows you our forecast for Michigan's unemployment rate, and you can see it's been creeping up recently from 3.6% this past June and July of 2023 to 4.3% as of November, which is the most recent data. And we're expecting it to tick up just a bit further to 4.5% in the first half of this year. But then it slowly begins to inch down over the remainder of our forecast to 4.2% by the end of 2026. And I just want to say, taken in context, obviously that is an increase. It's creeping up some. That's still a pretty tight labor market by historical standards. And this slide shows you our forecast for Michigan's labor force participation rate. And this was a real bright spot in 2023. And honestly, it came as a pleasant surprise to us because we had a couple of frustrating years, obviously coming out of the pandemic where, people would say, well, where are the workers? Does nobody want to work anymore? Or what's going on? Well, it turns out the workers were waiting for 2023. They were coming back in droves in 2023. And as of November, Michigan's labor force participation rate stood at 62.1%, which was more than 2 percentage points higher than at the start of the year. The reality is, as I'm sure people know, Michigan's demographic trends paint a less rosy picture going forward. With an aging workforce and slow population growth impeding, a lot more expansion of the state's labor force. And so in our forecast, the participation rate holds roughly steady over the next few years. This slide shows our forecast for local inflation, again, as measured by the Detroit CPI. And again, the blue is the headline measure, the yellow is the core measure. We estimate that the local headline inflation rate slowed from 8.2% in 2022 to about 5.3% last year. Although, as I showed you earlier, inflation was decelerating more quickly at the end of the year. And we do anticipate the disinflation to be durable going forward, with local headline inflation running at about 2.5% this year and slowing to 2.3% by 2026. The decline in energy prices and the significant moderation in food price inflation over the past year contributed to the slowdown in overall inflation. So as I mentioned, core has not slowed down to the same extent as headline inflation as of yet. We estimate that local core inflation came in at about 6.9% last year, but we do project it to slow to about 2.7% this year and then converge to the headline rate of about 2.3% by 2026. So this slide shows you our forecast for Michigan's personal income per capita in the yellow line and real disposable income per capita in the blue line. And I can see I need to speed up. So we calculate real disposable income by subtracting personal taxes from personal income and then adjusting for local inflation. So, it's a useful way to track living standards in Michigan over time. Personal income per capita, again, in the yellow line, jumped during the pandemic because of all of the stimulus. It hasn't really looked back. We estimate that it grew 4.6% last year to just shy of $60,000. It slows down a little bit this year to about 3.1%, again, with a little bit of a soft patch in the national economy, and then picks back up to 4.2% in 2025 and 3.5% in 2026. But those of you who have seen me present this graph before know that the story is a lot less rosy after you adjust for inflation and taxes to get to the blue line. And high inflation in 2022 took back nearly all of the gains in Michigan's personal income that we had seen in the pandemic. But we do now estimate that Michigan enjoyed 1.6% growth in real disposable income per capita in 2023. So that's a good thing to see. We've also become a bit more optimistic recently about the growth prospects ahead with some of the wage gains we've been seeing recently, for instance, in the recent UAW contracts and the slowdown in inflation. And our forecast calls for real disposable income per capita to grow by an average of 1.1% per year over the next 3 years. And that would take Michigan's real living standards in 2026 to about 5% higher than they were in 2019. So we have become a little more optimistic about that measure. Turning to revenues, this slide shows you our forecast for state tax revenues split into the general fund in yellow and the school aid fund in blue. And obviously the first thing that I'd like to draw people's attention to is the big run up in revenues we saw coming out of the pandemic from 2019 to 2022, when combined general fund and school aid fund revenues soared by $8.4 billion. And as I'm sure people know, revenues took a breather in fiscal 2023. Our preliminary estimates show a decline of about $1.6 billion in combined revenues that year. And obviously that drop didn't come as a complete surprise. I'll start with some of the economic factors that were at work, which are that we've expected to see a moderation in state tax revenue growth as capital gains fell off and consumer spending patterns shifted back towards services. Two indications of that moderation in fiscal 2023 were a dip in sales tax revenue and a large decline in quarterly income tax payments, which again are often influenced by capital gains. But even so, the dramatic fall of state tax revenue in fiscal 2023 was mostly due to factors related to the state's tax laws. First, Public Act 4, passed last year, expanded exemptions for certain retirement income, as well as the state's earned income tax credit, and added new earmarks to Michigan's corporate income tax. The new exemptions for retirement income and the EITC changes, however, don't take effect until fiscal 2024, so the current fiscal year. Second, Michigan's individual income tax rate fell from 4.25% to 4.05% for calendar year 2023 due to a provision of the state's 2015 road funding law. And Mike will be happy to take any questions on the details there. The third, revenue from the state's new flow-through entity tax fell substantially in 2023 to a more sustainable level in its second year of existence. So that's all about what's happened in the past. Looking forward now, in fiscal 2024, we expect combined general fund and school aid fund revenue to fall by another $560 million due to the new revenue changes and the moderate pace of economic growth that we're projecting. The general fund actually bears all of that decline, and actually just a little bit more. You can see the school aid fund ekes out a very small gain. We expect conditions to improve in fiscal 2025 and fiscal 2026, with both the school aid fund and the general fund recording solid growth. We forecast combined revenue growth of about $1.8 billion, or 5.8% in fiscal 2025, followed by another $920 million gain, which would be about 2.8% in fiscal 2026. Even with the revenue contractions in fiscal 2023 and fiscal 2024, combined revenues will be nearly $9 billion higher in fiscal 2026 than they were in fiscal 2019. And that translates to a gain of about 36%. And while that number sure sounds like a lot, it doesn't account for the elevated pace of inflation we've seen recently. And so if we adjust for local inflation, the growth of total revenues comes to about 5.5% cumulatively from 2019 to 2026. And that translates to an average growth rate of less than 1% per year after we adjust for inflation. Okay, so to wrap up, we're forecasting payroll employment in Michigan to make a full recovery from the pandemic recession in the first half of this year. Our growth continues over the next few years, but we do expect a little bit of a soft patch this year as Michigan grapples with high interest rates. Michigan's unemployment rate tops out at about 4.5% in the first half of this year and then edges down to about 4.2% by the end of our forecast period. Real disposable income per capita in Michigan grows slowly but steadily over the next few years. State tax revenue continues to decline this fiscal year, but growth returns after that. And as I mentioned, total revenues will be almost $9 billion higher in fiscal 2026 than they were in fiscal 2019. But when you adjust for inflation, that growth is less impressive. And just as a closing thought, I wanted to say that, despite our forecast that job growth will continue, high interest rates and announced layoffs in the auto industry do pose a significant near-term risk to our outlook. So thanks for that. Danielle and I will be happy to take any questions.
Thank you both. We have a few minutes still here for questions. Anything from the principal? Sure.
Yeah. Well, really appreciate the content as always, and thank you for making the trip up here with today's weather. A couple thoughts. I mean, I'll let you off the hook here with my traditional question about, when are we going to return back to normal from a consumption standpoint, given the nature of our next speaker. So Danielle's trend has held so far about some stickiness of some of those behaviors, so that's been great, certainly if you want to weigh in there. But I would love some more information or any additional thoughts you have about the workforce participation rate. And that's been a little bit of a, yeah, we're all agreeing it's the same question, so it's good news. That's been an area where as a state we've been struggling and falling behind, and to see this dramatic turnaround is really noteworthy. And I wondered if you have any additional detail or thoughts about what is driving that. Are there certain demographics where you're seeing return more than others, or any additional thoughts would be helpful?
Yeah, the first thing I guess I would say is, in a lot of ways, I think that the mystery from my perspective was why it didn't happen earlier. Because if you see, even with the great progress we've seen, we really are just getting back to where we were before the pandemic. And one thing you can see kind of coming in the 2010s as we came out, maybe you can't, I don't know if the pointer is working, but you can see that we saw a gentle upward slope in participation. And typically we think about there being, look at Danielle. We think about there being a trade-off between a strong labor market, really drawing workers into the labor force. So we typically think when jobs are easier to find, labor force participation rises because you don't count as in the labor force. If you're not working and you're not looking for a job, you're not in the labor force. But if you're looking for a job, then you're counted in the labor force. And so we think when jobs are more available, labor force participation tends to rise. On the other hand, the demographics, as you mentioned, really are weighing against labor force continuing to rise. So it's kind of that balance. And as I say, we had been expecting to see an improvement in labor force participation earlier than this. And so it kind of happened, it didn't happen, it kept not happening, and then it happened all at once. That I think is surprising, but it's just one of those things. But the flat kind of projection that we're showing moving forward really reflects that balance between a pretty strong labor market and an aging workforce.
And I think along those questions is, and I know in November we heard some presentations, how does the role of AI gonna play into this? Have you even looked at it in future employment, really?
Right, this is purely speculative, but it should help drive productivity in a lot of industries, so maybe it's one of the reasons why nationally we don't expect really, really strong growth going forward, but it's nobody knows for sure. So I went to a NABE conference this fall, and there were two different talks on the impact of AI on employment. Both of them featured what it's going to do to economists, and they said basically diametrically opposing things. So nobody knows for sure. It's a big risk.
Stay tuned. Any of our, a quick question, Representative Brixey?
Thank you. Thanks for the presentation. So my question is, this morning everybody woke up to some unrest around the world that's potentially impacting shipping. What do these overseas wars and conflicts, what impact do they have, and what potential do you see that we should be concerned about or keep an eye on?
Right. So I have a two-handed economist here. So first, it obviously disrupts supply chains, and there was an announcement just, I think, this morning again that Tesla is shutting down production in Germany because they have to wait for parts to go around Africa now. So that's a short-term disruption. We have a large military complex, which actually going to probably sell more. So on the economics of it, we'll probably get some boost from it. I'm going to abstract from, I'm not going to comment on what we should be doing. I'm just basically, we're going to have some disruptions to some sectors, and some sectors are basically going to benefit. Oil prices might become a risk again because the Red Sea is one thing, but Straits of Hormuz can be under attack, and a lot of global oil exports go through there. So that's another risk.
Thank you for coming here today. Curious, we saw a lot of speculation about the auto strike and potential impacts to our state's economy and revenues that it seems were larger than they ended up being. So any speculation on how that shaped up and what we should keep in mind for going forward?
Yeah, I think I agree with that statement. One thing to keep in mind is that the strategy that the UAW pursued was different, I think, than what a lot of people had assumed. Because if you look back to 2019 and some previous strikes, they struck an entire automaker, a single automaker, but all at once, company-wide strikes, right? And we didn't see those company-wide strikes. Instead, the strike started off targeted at just 3 assembly plants, and then it grew slowly over time. And so I think that because of that, and then the fact that it was resolved in a relatively timely manner, I think those both limited the impacts. We would have expected the impacts to continue growing over time had the strike continued. And one thing I think we really got lucky that it was fortunate is that it wrapped up before the holiday season. I think that helped and made a difference. And then the other, the reality is sometimes the media can be very breathless about a story. It's very topical. I'm not, it's one of those things where sometimes, you can get a lot of headlines for a story even if it turns out that the actual numbers aren't quite as big as they might have been in the past, so.
Thank you, appreciate it, as always. Our next speaker is Leslie McGranaham. She's from the Federal Reserve Bank of Chicago, and unfortunately, she could not make it in person and will be doing a Zoom presentation for us. Leslie is a Senior Vice President of Regional Analysis and Community Development at the Federal Reserve Bank of Chicago. Her primary research interests relate to the effects of federal, state, and local government policy on individuals and households. She has written about numerous government programs, including the Earned Income Tax Credit, the Child Tax Credit, the Supplemental Nutritional Assistance Program, and the sales tax. She closely follows regional and national developments in government spending and revenues. Leslie received a bachelor's degree in politics from Princeton University and a master's and doctorate degrees in economics from Northwestern University. Welcome, Leslie. Can you hear us okay?
I can hear you fine. I am not successfully sharing my screen yet, so I don't know.
Okay.
I don't know if it's easier if someone can share my slides there and I can just tell you when to advance them. Is that possible?
Sure, I think so. Oh, we don't have them on here? Oh,
Hi there. We just made you a
hang on, let's
co-host, so hopefully you'll be able to share your document.
we have them on our website, and I don't know if that changes anything, or? Oh, so Leslie, they made you a co-host?
Yeah, it's not
Okay.
happening. We're not the most Zoom friendly place in
That's
the
right,
world.
we're
so it's
working on
not
loading your
completely
presentation
unheard
right
of.
now.
I can try joining from my other computer, or if you have I don't know if it's easier if you can share the slides from there or if I have to share them from here. Let me see.
Sorry.
Okay, so we were able to load yours on our screen here.
Okay, so you can see me and you can see the slides, and I can just tell you when to advance. I think it's probably the
Okay, so your
easiest.
screens are now showing on our video monitors. So go ahead when
They are
you're
not?
comfortable. Yes,
They are. They are not.
They are on the screen right now.
Okay, terrific. So thanks for having me. Sorry I couldn't be there. I actually was in Michigan this week and was planning on staying, and it's now blizzarding here. So that's always the risk of January in the Great Lakes. So, just wanted to start first, thanks for having me. And second, just to say that the views are my own and not the views of the Federal Reserve Bank of Chicago or the Federal Reserve System. So I am going to talk about the economic outlook, really pretty similar to some of the slides that Daniil showed, but adding sort of the Midwest perspective. So if you turn to the next slide, which shows a couple maps, I'm going to talk about the national economic picture and how it maps into the Midwest. And then talk a little bit about like the outlook with some additional Midwest context, and then some risks to the forecast. When we're talking about the Midwest, there's sort of some different groupings that we're talking about. So if you look, the Midwest census region, which is in the pale blue, that's the way the census defines the Midwest. The Bureau of Economic Analysis, which makes the GDP, which puts out the GDP numbers. The region most closely aligned that contains Michigan and Illinois is in the green, and that's the Great Lakes region. And then finally, the Federal Reserve Bank of Chicago, our responsibility is for all of Iowa and the majority of Michigan, Illinois, Indiana, and Wisconsin. We say we have 91% of the economic activity of the states that we don't cover the entire geography of. So at some points, I'll be talking about the 7th district states, and those are the 5 states of our district. So just kind of wanted to set out those groupings. So if you look at sort of the next slide, the setting the Midwest context, there are 2 features of the Midwest that are really important in kind of in setting the stage. First is that population growth in the Midwest is slow and has been slow for quite some time. So if you look here, these are the 10-year percent changes in populations over a number of, based on quarterly data. And the top line is the 10-year population change in the US, and the remainder of the lines are in our 5 states, all of which are slower than the Midwest. The slowest has recently been Illinois, but Michigan is also, the population growth, as you well know, has not been at the US level. The other thing to keep in mind, and this is my slide 4, is the industry mix within the Midwest. So this is the green map that shows the concentration of manufacturing as defined by this, the location quotient, which is just the ratio of the employment share in a place relative to the employment share somewhere else. So how much more concentrated we are in an industry than elsewhere. And if you look here, the top 4 most manufacturing employment concentrated states in the country are actually within our district. And so the highest concentrated states are in that dark green, but the 4 most concentrated states are have the numbers on them. And what this means is, like, in terms of percent, Indiana has twice as high of a concentration in manufacturing as the US as a whole. Michigan is 4th here, but still is quite a bit more concentrated. And that's a really important piece of the context. So we have a lot of manufacturing and we have slow population growth. These are, of course, very, very connected to one another, but they're super important pieces when we think about the context. So that's sort of the Midwest. And we think, if you move to slide 5, so slide 5 shows what's happened with economic growth overall, and sort of, again, like stepping out a little bit, that as Daniil mentioned, like growth last year really surprised to the upside. As we were sort of having conversations at the beginning of last year, almost everybody was predicting some sort of a slowdown or potentially something that you would, like a recession in the second half of 2023. And instead, what you can see here is that Q3 of 2023 had like extremely robust growth numbers. And Q4, even though it's expected to come in a little bit, like quite a bit slower than Q3, if you average out across these 2 quarters, it's a really, robust second half of the year, and quite different from what we were initially expecting. The other thing just to note on this graph is that that red dashed line is the sort of longer run forecast, sort of where we expect, given productivity and population growth, for the economy to grow kind of in sort of what I'd call like normal times. And if you look, like 3 of the 4 quarters of 2023 were above that. So, growth was solid and surprised to the upside. So what about the Midwest? So this is slide 6, which says growth mostly weaker in Midwest. This uses that same data source and looks at what economic growth looked like by quarter at an annual rate. In blue is the U.S. numbers as above. Red is that Great Lakes BEA region, and the green is the state of Michigan. And the state data can be a little volatile. I think the thing to note here is, other than 2022 Q1, where the red bar is less negative than the blue bar, in all of these other quarters, Great Lakes growth was slower than growth nationwide. And if you like, this is not atypical. So if you look at the next slide, which is slide 7, it's not as pretty, but this shows what that growth has looked like at a longer horizon. And often we see, that the red is below the blue, meaning that economic growth in our region has tended to be slower than economic growth nationwide. Okay, turning to slide 8 and thinking about, sort of what has been driving nationwide this super robust growth. And that has been, as Danielle pointed out, led by a really resilient consumer. The blue bars are the contribution of consumption to real GDP growth, and consumption growth has been robust, really, throughout the economic recovery from the pandemic recession. So if we look at this, there's a lot of blue on this graph, just really noting that consumption has really held up. If I turn to the next slide and sort of say so that is through the end of 2023 Q3. We get pretty timely data on consumption through the retail sales survey. So this next slide that says the consumer has been spending, this is what's been happening with real retail sales, and adds in the last 2 months of data that we have for the most recent quarter. So as I said, we don't have the GDP data for Q4 yet, but we have 2 months of retail sales. And if we look at this is not particularly bad news. And I think as we hear from people, it seems like the fourth quarter, that like super important quarter from consumption, that retail sales sort of on average kind of held up. So the consumer has been spending, and it hasn't certainly didn't seem to collapse towards the end of the year. So again, looking at the consumer, the next graph is about consumer sentiment and consumer confidence. There are two popular measures of the consumer's, sort of well-being. One is from the Conference Board, and one is from the University of Michigan survey. And you sort of look at these, and my conclusion here, it's really hard to make heads or tails of the consumer's level of confidence. On the one hand, we know that they're spending a lot. On the other hand, consumer confidence is quite a bit below where it was early in the pandemic recovery, and certainly prior to the pandemic. So the consumer is, consumers have jobs, but inflation has been bad, and confidence, which is usually like a really good indicator of sort of where things are going forward, has not been as good of a sign or an indicator in the recent past. And in fact, when Gabe and Danielle hosted the conference at RSQE late in 2023, we had this like really profound dip in consumption in both confidence and sentiment. And we were sort of asking these questions about, why is the consumer spending so much when they're so negative? And some of this, and some of that kind of got moved away from the surveys. So, we're looking at the consumer, and the consumer's been pretty robust. And I just wanted to dig into a couple things going on that side. First is, sort of this next slide, which is slide 11, which says different patterns for goods and services. And I'm sorry if the print here is a little small, but I wanted to point out here is as consumption has recovered, the trajectory for goods and services has been quite a bit different. And the top blue line is where goods consumption has been in real terms relative to January 2020. The sort of pale green line is services, and the red is the average. So both are quite a bit above their 2020 level, as we would expect in a growing economy. But goods consumption has been, on average, quite a bit more robust than the growth in services consumption. Now, the graph on the right, shows this in quarterly growth rates at an annual rate. And what you can see is that there were these periods where goods was growing much, much faster. But if we look at where we are now, goods and services, like these lines, have kind of converged in terms of growth rate. So we have the story of like goods kind of like just rapidly kind of going as people had a lot of money and were able to consume right out of the as we started to recover from the pandemic recession, and services kind of caught up, and now it looks something like they're much more equal and kind of much more normalized. So, one of the things, if you sort of think back and kind of look at the next slide, is that, we in the Midwest, we specialize in the production of goods. And so, like, we're manufacturing heavy, we make goods. Goods had this unusual trajectory in terms of timing. And so, my question was, does the industry mix partly explain the GDP patterns by state? So as I noted, the Great Lakes states have been growing more slowly, and we specialize in goods, and goods had this unusual pattern. Does that explain things? And the answer is, well, that seemed like a really good theory for a while, but the more recent data draws it into question. So what this is here is the dark blue bars is the overall economic growth. The red is U.S. manufacturing. The green is what's happened with growth in Great Lakes manufacturing, and then I put in Michigan as well. And if we sort of look at the difference, just highlighting the difference between the blue and the red, what you see is that that manufacturing was growing more slowly than overall manufacturing, like GDP was growing more slowly than overall GDP through the end of Q1, but Q2 and Q3 actually the growth in manufacturing has been stronger. So this was kind of a good theory when I originally made these slides, and as is often the case, data kind of draws that narrative into question. So sort of thinking about, sort of turning back to the consumer for a moment, and the consumer who's really, again, like been driving things. If you could pull up slide 13, which is sort of, so how is the consumer? Danielle and Gabe both pointed out that, as we look towards the future, we're going to be thinking a lot about how the consumer is doing. And the consumer has been drawing down their savings and may not have the firepower to continue to consume at the same rate as they have. So if you look, I think the more telling graph actually here is the graph on the left, which is based on some work that was done at the San Francisco Fed that looks at what has happened to the stock of excess savings. And this shot up through all of the federal fiscal stimulus and support in during the pandemic. And that has slowly, as people have started consuming more, that has slowly declined. And now, according to this estimate, there are different ways of estimating these measures, and this is just one. But according to this estimate, that has kind of run its course. And so, we're almost back down to zero. So meaning like the consumer had all of this excess savings, and that has largely gone away. The second thing to note for the consumer is there are some modest signs of stress appearing. So the next slide shows data from, this is not data from the BLS, this is data from the Consumer Credit Panel, and shows what's been happening with newly delinquent balances for households. And there are a couple things to note. So if we look at the black line, which is all balances are really are quite low, right? So like, certainly exceedingly low. These are delinquent balances, certainly exceedingly low relative to, sort of the Great Recession, and low by historical terms with just a little bit of a ticking up. Some of this is caused by student loans, but a lot of this is mortgages. There's not a lot of delinquent mortgages balances currently. A lot of people have benefited from refinancing their mortgages, and staying in very low rate mortgages. So mortgage balances are low, delinquent balances are low, and mortgages are the lion's share of this. But if you look at something like credit card balances or auto balances, we're seeing these signs of increasing delinquencies that can kind of get kind of averaged away when we look at something like all balances because of how much mortgage balances are bringing things down. So we are starting to hear from the auto lending sector and from the credit card sector that the delinquencies are moving back to kind of pre-pandemic levels from being substantially below them. Fortunately, so that's kind of a little bit of a concern, especially when it's matched with the notion that from the previous slide that like these balances have been drawn down. So if we turn to the next slide, if we turn to slide 15, so we are this data is also generated by the Consumer Credit Panel for a selection of states, which includes both Illinois and Michigan. The reason I only put up Illinois and Michigan from our district is because those are the only two states where data are made available from the Consumer Credit Panel. And if we look at this is that same measure of delinquent balances measured it's slightly different way, but this is the way that they put it out. And you can also see that there's not a different narrative in Illinois and Michigan. So this doesn't seem different in the Midwest, but it does seem like this underlying story of credit deteriorating on the margin is also occurring here. Okay, so turning to the next slide and thinking about the labor market, some of this is I'll go through some of this more quickly because it's very repetitive of Danielle's slides, but so the labor market remains pretty robust. This again is the graph of the change in non-farm payroll employment. And the thing to note here is just that yellow line, what trend growth looks like. So this is sort of where we think the trend is based on kind of population. So about 85 population growth gives us about 85 to 100,000 added employees per month, and we've been substantially above that for quite some time. Now, how does this translate in the Midwest? The next slide says Midwest employment growth rates below the nation. This puts up that same measure, but looking at the 7th district, so our 5 states relative to the United States, and employment growth has been in our states has been below the level in the United States. Those dotted lines just show what that has looked like over the last 10 years, just to demonstrate that this gap is very typical. So, historically, because our population hasn't been growing as quickly as the rest of the country, and because our industry mix, this has been we're kind of back to sort of what we would consider the standard in the employment gap. A little more on the labor market, just generally, the labor market is cooling. This is, so that's slide 18. The labor market is cooling. this is, so on the left is what's been happening with job openings. We see them cooling. I added on here the in red job openings in construction, because that is one area where we hear a lot about like robust demand for labor, especially as like some of the, like the federal programs, the ARPA and IRA dollars are coming in, that there's been a lot of demand for construction. And so I think, there's this, like as we talk to people in the construction sector, we hear like, oh my gosh, the labor market is so incredibly tight. But sort of overall, the job openings have cooled, showing that the labor market is cooling. We also see the labor market cooling from the perspective of hours worked, which is shown on the right. Okay. Turning to participation, I'm going to take a few minutes. I appreciate your question at the end there about participation. So this is a picture of so this is slide 19, a picture of what's happened with labor force participation nationwide. And so labor force participation has been really come back. There are a couple groups that have continued to lag. You see here in the orange, the 55 plus, just how labor force participation of the 55 plus hasn't returned to where it was pre-pandemic. At the same time, if you look especially at 25 to 54-year-old women, sort of a group that was very impacted by the disruptions to childcare and other things during the pandemic, those labor force participation rates are as high as they've ever been. I know that was true with some of these dashes that they've kind of come down a little bit, but participation has increased quite robustly back to where it was. But there are some groups that are lagging, especially older people. Now, if we look at slide 20, this is sort of taking a broader aperture on what's going on with labor force participation rate. So the red is the trend that is a trend rate of labor force participation, where some of my colleagues have looked at national demographics and kind of projected out what labor force participation would look like. And then the blue is kind of the historical level of labor force participation. So there are a couple things to note here. One is just that this trend's down. That is the aging of the population, kind of where we've been expecting labor force participation to trend down. What we see is, sort of look at the period right before the pandemic, labor force participation was quite a bit above trend. That's something that happens, when the economy is robust, it pulls people into the labor force. If we look at kind of where we are now relative to trend, compared to where we were pre-pandemic relative to trend, we're in a very similar place. So that's why I kind of put on this slide, it seems like there's limited additional upside. Labor force participation and this increase in participation has been a really beneficial supply side force for the kind of what President Goolsbee tends to call the golden path, like this notion that growth has been robust and inflation has been coming down, and a lot of that has been helped on the supply side, including by labor force participation. But there's just a question of, given where we are relative to trend, how much more room we have to run. The next slide says Midwest participation usually higher. This shows labor force participation in our 5 states. I wanted to take a moment here to talk about a couple things, in part in response to your earlier question. Something has happened with Michigan labor force participation in the past, like towards the end of last year. Like, it really shot up. I think it's as close as it's been to the national level, as it's been in quite a long time. There are, like, one of the things that this makes me want to do is really dig into these data and try and understand who it is that's participating more and what is driving this. But I also want to note that we were having like really kind of deep conversations about labor force participation earlier in the year. If you look at the red and the purple lines, which are Illinois and Wisconsin, what you see here is there was like a couple months where the participation rate in Illinois was higher than the participation rate in Wisconsin. That is one of those things that never happens. And so one of the things that makes me worry a little bit about is just the underlying quality of the data. So, I think there's some argument to really dig into the labor force participation story, because there have been some really dramatic things that have happened. One is this increase in Michigan, and second is that is sort of the relative decline in Wisconsin. So just, noting that, participation has had some sort of some dramatic behaviors. Okay, so that, sort of stepping away. So the labor market has really benefited from the decrease in participation nationwide. Signs are that it is cooling. Going to turn a little bit and talk about inflation. So that is, and again, this is pretty, Danielle had very similar graphs. This is, we got new CPI data yesterday. So these are pretty hot off the presses. So if you see the slide 22, it's progress, but inflation remains high. And I think, this is, inflation has come down quite a lot, especially if you look at something like, instead of looking at an annual change, something like a 3-month change. But I think that something like a victory lap is quite a bit premature, because inflation is still quite far above what we would, like the Fed's 2% target, which is the target for PCE. CPI tends to trend a little bit above PCE, but there's been great inflation news, but I think inflation is still above ideal levels. The next slide just kind of reiterates that sort of as we think about the trajectory of inflation, we're looking at the components. Core goods is sort of back to zero. So goods inflation, which has traditionally been below zero, in quality adjusted terms, goods prices often fall. So we're kind of, that's run its course. Housing services inflation has come down. We anticipate that will continue. Just, as Danielle mentioned, some of the incoming data like Zillow rents, and I have a graph of that, but that's kind of been covered, have come down. And the thing to watch is this core services X housing, which is like a big portion of this category. And we expected it to be a little slower, but that's an important sector to watch. So I wanted to dig in a little bit and talk about inflation within the Midwest and inflation in Detroit. This is an area where I've been doing some research, and I'm pretty geeked out about this topic. So if we look at the next graph, it says inflation within the Midwest and what has been the inflation story here. If we look at this is inflation starting in 2020, annual inflation. The thing to take from here is that inflation in the Midwest has not been at all, an outlier. In fact, if we look over this entire period relative to the other regions, the Midwest has been the closest to the national average. Northeast inflation has been below it. You can see that. And inflation in the West over this entire time period has been higher. In the recent readings, Midwest inflation has been, pretty close to the national average. We don't have inflation readings for states. We do have for cities, but for some big cities. So I'm going to just looking at the next slide. Is this largely a housing story? Is the differences across regions largely a housing story? And I would just, I think you may find the Detroit, like the work on Detroit more interesting. So just to note here is if we kind of look at housing and we take that out of the calculations, that explains, so, changes in the price of housing, goods, and services explains most of the gap in regions in inflation. But I want to talk a little bit more about what's on slide 26, which is kind of digging into this question of why has inflation been higher in Detroit. So the BLS puts out inflation data for regions, the Midwest, and for a series of large cities. There are 4 cities in the Midwest census region where there are inflation data: Chicago, Detroit, Minneapolis, and St. Louis. This data is released every month in Chicago and every other month in the other three cities within the Midwest. And so this is a graph of what inflation has looked like in these cities since 2020. And you can see that inflation in the Detroit metro has been higher than inflation in the Midwest, and Detroit and inflation in St. Louis has been lower. So why is this, why is this the case? And so if you look at the data, inflation in a place is defined as what people in that place buy and how how those goods have increased in price within those places. So, there's a market basket that people in Detroit buy that might be different than what people in the Midwest buy as a whole. For instance, individuals in Detroit buy a lot more like automobile related services than individuals in Chicago, who rely much more on public transit. And then the BLS separately surveys prices in these areas. So this graph on top that says that the Detroit graph on top does 2 things. It takes sort of what Detroit inflation is, and then it divides it into 2 pieces: the part that's caused by what people in Detroit buy, that's different from what people in the Midwest buy, and what's happened to those prices as compared to what's happened to prices in the Midwest. And what you can see on the far right is that there are 2 lines that are completely on top of each other. And what that is telling us is that the entire reason that the green line has been above the red line on the right, so Detroit inflation has been higher, is because it's not because people in Detroit are buying different things. It's because the prices of things have been growing faster in Detroit. So within a category, the prices have been growing faster. And then I sort of dug into, to what extent is this housing? Is this really about housing? So instead of using the Detroit housing price index, so what happened to the price of housing, goods, and services in Detroit, I substitute in the Midwest housing price trajectory, and that's what you get. That's where you get the green line on the bottom figure. And all that's telling us is that the majority of the reason why inflation has been higher in Detroit has been because the changes in the price of housing, goods, and services has been more robust. Now, why that is not something that I haven't dug into, but I just wanted to make that point that like Detroit inflation has been higher, and that seems to be almost exclusively a story about housing inflation. Okay. So sort of stepping back and sort of talking about inflation overall. So, again, like Detroit, like inflation overall has been falling. So that was a relative question. Returning to the absolute question, and then you can turn back to slide 27, that inflation overall has been falling. This has been, exceedingly good news. The increase in labor force participation on the supply side has been one of the sources of that. Also, just the supply chain has been healing. We could maybe even say, as a title here, that the supply chain has healed. So when we look at this global pressure supply chain index, what we see is it's back to its long run trend. So it's back to it's back to its average. And so the supply chain is better. As you noted, that the supply chain may, if the supply chain gets disrupted again, we could end up seeing inflation coming back. And we've really, like, I think one of the lessons from the pandemic is how crucial the supply chain is to inflation. I think we can skip slide 28. That just shows on rents. The other thing just to note is that the kind of the last remaining really big concern on the inflation front was the decline. What's happened to the decline in non-housing services. Now, non-housing services are very labor intensive. And so if we think about that, those are really connected to wages because they're very labor intensive. And so this just shows, like, every measure under the sun that you could look at for what's been going on with wage growth. Wage growth has been slowing, which is good news for the inflation rate of that part of core inflation. So in all of this context, monetary policy has tightened. The slide 30 shows the federal funds rate, the target rate. So in monetary policy has tightened. I think the more interesting version of this, actually, if you look at slide 31, you see how fast monetary policy tightening occurred relative in the tightening that began in 2022 relative to past tightening cycles. In reaction to inflation, monetary policy has gotten quite a bit tighter and quite a bit tighter much more rapidly. This is translated into higher interest rates with the goal of slowing demand. That is shown in slide 32. So interest rates have went up quite a lot. As Danielle mentioned, interest rates have come down quite a bit recently. And a lot of this is actually since we met at RSQE a few months ago, that interest rates have come down in part because the inflation picture has gotten so much more optimistic. But it's sort of like a little bit of like interest rates are still very high by recent historical standards, even though they've gone up a lot. In this context, activity has moderated. That is the next slide. Just to note that you can see, especially on the right, that the way that the decline and rise in interest rates has translated into the housing sector. The other thing, just kind of to note, that inflation expectations have been pretty stable. That has been a really helpful feature of this environment and has helped it. Has kind of been a crucial piece of the picture from the perspective of the ability to get inflation down. If we look at, so the Michigan survey, there's a slide that says stable longer-term inflation expectations. And if you look at these inflation expectations, we would say that they are well anchored. So inflation expectations, and people have been pretty confident that inflation was going to come back down. I just wanted to note that if you look at the blue line on top, the 1 year ahead, we had a bit of a scare where inflation expectations had gone up quite a lot. And there was a concern that, that consumers kind of were, this anchoring was kind of coming undone. And then in the most recent reading, this reversed itself. So the next slide is just sort of, I've gone through a lot very quickly. I hope it's been okay to follow along. I'm sorry for the sharing trouble. As I mentioned, Zoom can be very tricky for us. But just taking stock, we've had really robust growth. The labor market is slowly cooling, but there are some signs of cooling and pretty broad signs of cooling, but nothing super dramatic that suggests like that we're on the verge of a recession. Inflation has been coming down, but it is still high. Just want to note that it is still higher. There's still some work to be done and some progress to be made on inflation. It's really aided by the improving supply environment. If we take that to the Midwest is growing more slowly. We have, less population growth, less growth in the labor force. Those are things that are long-term and structural, so they've been going on for a long time. We also have more goods, and sort of my story about about that kind of driving some of the differences seem to be a good story, but maybe seems like less of a good story with the most two recent quarters of data. So what is sort of the outlook? And for the outlook, I just want to talk in terms of the summary of economic projections that's put out by the Fed. I think like one of the, I'm just going to highlight a couple slides here because I know I'm sure you have some questions is, if you look at slide 37 and you look at what the projections were, so SEPs, comes out quarterly. And so we had the most recent SEPs came out in December. Taking a snapshot 6 months earlier and then a year earlier, I put these three lines in the graph, and you can see how much better the GDP picture was than was anticipated in December of 2022, and then in June of 23, and then in December of 23, things look quite a bit better. So we got a lot of really good news on the upside on inflation. On GDP. If you look at the next slide, this also translated into, more benign projections for the unemployment rate. So the unemployment rate in December's projection, the data and the projections are below where they were in June. And then inflation came down, again, this is slide 39, came down more rapidly than was anticipated in either December or June. And then I just want to finish on, with slide 42 and just ask about this is a very benign picture of the economy. Inflation continues to come down. Kind of by the end of the forecast horizon, it's down to 2%. We avoid a recession, and the unemployment rate, although it goes up a couple ticks, is still like really consistent with, kind of a full employment economy. So that's a really benign forecast. So what are the risks to this benign forecast? And I think there are sort of three that I wanted to highlight. One is the risk of over tightening or additional tightening. So monetary policy tightening that needs to clamp down, that either has clamped down too much or needs to clamp down more. So it could be that, monetary policy translates with long and variable lags. So too much tightening could have been put in place, and that could dampen the economy more than needed. Inflation could end up being more persistent, and that we need to tighten more. Like monetary policy needs to be more aggressive. The other thing is that non-monetary policy could be tighter. This is either the fallout from banking stress or from commercial real estate. So there could be more financial tightening that comes from those things. The second real risk is from external shocks. We've had sort of been able to say hey, this looks like a soft landing is going to occur in the past, and external shocks have derailed us in the past. There's lots of different potential shocks, and in some ways, it's the shocks you don't expect are the ones that tend to cause the most trouble. And then finally, the consumer could retreat. As I mentioned, consumer confidence has been really hard to read. There are some signs of debt, delinquencies increasing, and sort of less in consumers' pocketbooks. The consumer has been supporting the economy, the U.S. consumer is sort of like the atlas of the world, as they say, and has been really supporting the economy. So what is the key going forward? I think monetary policy is going to continue to be important to watch. The pandemic related distortions seem mostly resolved. Supply side is kind of back to normal. Pent-up demand seems to be back to normal. And so this last trend towards getting inflation all the way down is really going to depend on monetary policy. So thanks, and sorry, I hope the slides were okay to follow without my ability to share. And sorry I couldn't be there in person, and happy to take questions.
Well, thank you very much. Yes, we could follow the slides great, could hear you, and I really appreciated the presentation, especially being able to compare the U.S. with the regional components on all of the information that you provided. That was very helpful. Questions up here? Representatives? So I'll ask you the one question that I did ask RSQE on employment and labor force related to AI. Have you at all looked at that? And maybe even on a sort of a regional basis, is AI play bigger in some areas than others? Do we need to be worried about it? It feels like it's coming. Any thoughts on that?
Yeah, I think from, it's certainly like, it's certainly like a big topic of conversation. And there's a question of like, what does it do and what do you kind of make of it? I think there are a couple things that I would say that we're watching particularly closely. One is just, like, what does this mean for the, what does this mean for the labor market? Like, who is likely to be impacted by AI jobs? It seems, like, I like the economists could be gone and the economists could be in charge. It seemed like being like the two different paradigms, but it seems like, that like there's quite a bit of talk and some really interesting research on the jobs that are most likely to be impacted by AI. I think the other piece that kind of that I get pretty excited about is trying to think about what AI means in a manufacturing context, just given our footprint. And AI might not be, first to go into manufacturing. Like, it seems like in like kind of, it's, the first stories are kind of in the knowledge and information part of the economy, but there's an interesting manufacturing layering. And, like one of the stories we heard recently was about like AI's ability to like look at quality control for output. And so I think, like that's going to be something that increases productivity and efficiency, but could increase like safety. But I think it's like, again, it's like really early. So I think it's a great question and a great area of discussion, but I think I'm more of like a fellow traveler on this one at the moment than really an expert, but it's something that we're thinking a lot about and trying to figure out where to kind of leverage our expertise and learn the most. And I think for me, I think it's really interesting to try and think about how AI is going to impact and affect manufacturing, given that that's sort of where the region seems to specialize.
Thank you, appreciate that. Oh, we do have one follow-up question.
Yeah, I just didn't want to be accused of stealing questions again, so I didn't want to go first. So I really appreciated your comment about the fact that the consumer is exceedingly hard to read right now, and this kind of disconnect between sentiment and behavior. And obviously, as state forecasters, we've got to think about this real impact on state revenues. And one of the things that's been kind of hanging out there is, is there any trends or indicators that might think that we're approaching pre-pandemic behaviors, or there could be a trend towards pre-pandemic behaviors? So I didn't know if there's anything in your data that might indicate, that could be a risk in the upcoming years.
That just you broke up a little bit, just like just the notion the consumer is kind of returning to pre-pandemic behaviors.
Correct. Thank you.
Yeah, I think that like the theme of the past maybe like 3 to 4 months has really been about normalization, right? That like everything seems to be normalizing. I mean, I think the one thing that's kind of not normalizing is probably affordability, both for the consumer, both, on the auto side and on the housing side. And so, insofar as we're not normalizing completely, I would attribute a lot of that to just, that interest rates are still high relative to like a lot of the experience of a lot of current consumers. And and as a result, and from other factors, affordability is a challenge. So it's like, like normalizing seems to be happening, like that goods and services, like those goods and services lines converging, to me seems to say normalization, and pent up demand is sort of, seems to be kind of, that story seems to largely be over. So I think that, I think worry relative to saying like, okay, maybe we just go back to kind of the trends we were assuming pre-pandemic is really taking a deep look at what the affordability, especially in the housing and auto sectors, mean for the consumer. Does that kind of answer?
Absolutely. Appreciate it. Thank you.
Oh, and we have one more follow-up question.
Thank you, and really appreciated the presentation. So, slide 13 has your chart of the drawing down on savings. And obviously, the balances are approaching nothing after high, being very high. So combining that with, the expected less affordable housing and autos, and, just, can you talk just a little bit more about sort of a longer-term outlook on consumption? Because credit card rates obviously are, if people, I know we, pre these balances, people were using a lot of credit, but credit was cheap. Credit is still expensive, so just a little bit more on that, if you wouldn't mind. Thanks.
Yeah, I think, I pulled up slide 13 in front, like the consumer has continued to surprise us. I mean, I think that's like the resilience of the US economy has been kind of remarkable. So even though I can look at these data and I can say, wow, I'm concerned about the consumer, and I'd be interested to hear sort of how Gabe and Daniil would think about this as well. It's like the consumer has been, there's lots of reasons to think the consumer, could going forward retreat a little bit. The arguments for it is sort of like, the stock of savings. The argument against it is that the labor force and has been so robust. Not only participation, real wages are starting to go up as inflation has come down. So real wage growth, and so there's some reasons to think that the consumer still has some resilience left in them. But I think the main thing that keeps me against being too negative is just the consumer has surprised us to the upside, has been more resilient for quite some time. So I kind of like, that's my other hand reaction. But I, and sort of thinking out loud, but there are these forces that make you worry on the affordability, on savings coming down, on delinquencies going up. And yet at the same time, the labor market continues to be very robust, right? The unemployment rates are really low. If we do continue to see real wage growth, especially at the lower end, that's really supportive of consumption. And, and despite it all, whatever's been going on, the consumer has continued to spend. So I think that, when you start to get negative, I kind of feel reminded of like, I was worried, I've been worried in the past and the consumer is surprised. And I think that, some of the data are still coming in, but this holiday season was not particularly bad, and even relative to pretty robust comps. So I'm a little wary to underestimate the resilience of the American consumer.
Thank you very much. We appreciate it. Good luck with your snowstorm. We'll now turn to...
No school today, too, so that's...
yeah, no school around here either, and I don't think there's any snow yet.
Well, if you're getting this, you're in for a good one.
Thank you. With that, we'll move to our joint presentation from the House, Senate, and the administration on the economic outlook and revenue estimates. So we have Ben Gilchek from House Fiscal. He's new to us here, not new to the fiscal agency by any stretch. David Zinn from Senate Fiscal, and Eric Busses. So please begin when you're ready.
I'll steal yours. Okay. So I'll start things off with a review of recent economic and revenue events, I guess, for lack of a better term. Eric will follow up with what's going on with the major taxes, and Ben will conclude things telling you about how this affects funds and some other constitutional sort of implications. In terms of the economic outlook that the three agencies have, rather than put up another bunch of comparative graphs, many of which would look much like both Leslie's and Gabe and Daniil's, we all expect GDP to continue growing at relatively trend rates, like Leslie's graph with the line that had growth a little below 2%. We're all kind of looking at the same sort of thing, basically tight labor markets, labor force increasing about 0.7%, productivity being between 1 and 1.5%, and you're going to get about 2% growth, and we're pretty much maxed out at that. We do expect wage and salary employment growth, both nationally and in Michigan, to slow but still be positive. We expect inflation to fall for all the reasons you've already heard about, from about 5% this year to by the end of 2026, we're getting pretty close to the Fed's target. And compared to what we've had in previous decades and stuff, the unemployment rate will be relatively low. We basically don't have unemployment rates breaking much above 4%, much like with Daniil's forecast. For the Michigan economy, it'll pretty much be the same path, but like Leslie highlighted, the Midwest and Michigan struggle with an older labor force, and so all the growth rates will be a little bit less than they will be nationally, but there will be enough growth, particularly on the wage side, to help personal income rise as inflation comes down. In terms of building on Gabe's discussion about the UAW strike, as was mentioned, a lot of media coverage about how this was going to be the sky is falling, and it kind of didn't happen. Our view of it was looking at withholding, particularly if you look at it on a specific sector, transportation equipment manufacturing. If there's going to be any sign of it, it ought to show up here. And if you look at this slide, well, it's not really there. And if you blow it up more to the Michigan economy, this is something about like 5 to 6% of just withholding that we get. And if we can't see the noise here, you're not going to see it elsewhere in the economy. So that worked out quite well because we did not forecast a strike when we met in May. So we highlighted that as a risk, and as it turned out in May, we did a relatively good job both for the economy and for revenues. There are 5 revenues that account for about 90% of combined general fund and school aid fund revenue. That's income tax withholding, sales taxes, use taxes, the corporate income tax, and state education tax. And you can see here that we got the growth rates pretty close. A few of them were stronger, a few of them were weaker. We ended up missing, for these 5 revenue sources, the total by a little over $4 million on a $28 billion base. So taking the opportunity to pretend that we're making a victory walk, we won't point out when, after a number of years of having billion-dollar revisions here at the conference, we, in May, basically got these 5 taxes within 0.02% of the right number. So nice to not have, guess what, revenues are going to be off by several billion. We did have 2 major misses relative to May. One was individual income tax refunds, and a lot of this actually doesn't have to do with estimation error as much as accounting. In May, we thought that the accounting rules would require the earned income tax credits for tax year 22 to be paid in a way that would get put into FY24 accounting. And so we kind of had a double payment up in FY24. Turns out we can book those in FY23. And so about $400 million of this $468 million miss is because we moved what was going to be FY24 refunds into FY23, lowers 23, it will show up in the forecast as raising 24 because we simply move these refunds. The other big miss, kind of offsetting what happened on individual income tax refunds was what happened with general fund non-tax revenue sources. And as you might guess, with the fact that it's non-tax, it's not keyed to a lot of the economy. And there's a lot of different components that come in here. Some of them are fund transfers from some other funds, lapses of certain types of federal aid, and net, we ended up making about $400 million more on that, and almost all of it was because of interest earnings on common cash. I'll point out on the interest rate of the graph on the right side, we pretty much forecasted this sort of path for interest rates. Like with the economics that we had for the rest of the economy, we got the interest rate path pretty solid, but we missed what balances were going to be. And as you can see here, in terms of these general fund earnings, it used to be something like, $5–10 million, sort of thing. And we had a pretty large forecast. We were forecasting over $300 million in May, but we ended up with over $600 million. So the overwhelming majority of the non-tax miss is because we had a lot of money sitting in the bank waiting to get spent, and interest rates went from basically 0 to 5%. Back on the theme of individual income tax refunds, it used to be a fairly stable sort of number for us. It grew at fairly nominal rates from year to year, didn't jump around a lot, and we got to COVID, and there's been a steady stream of kind of one-time phenomena that have pushed the numbers up. We changed the homestead property tax credit to have inflationary adjustments. We had a retroactive exemption on unemployment compensation and exempting it from the income tax. We passed the flow-through entity tax, and there were timing issues that resulted in a whole bunch of refunds. And so we've seen them spike up quite a bit since COVID. We do kind of expect that they will resume a more normal trend, but because of a lot of these changes, they're probably going to remain at a higher level going forward, even if they return to a more stable path. And with that, I will turn things over to what's going on with revenue with Eric.
Great, thanks, David. So David did a great job of talking about our economic outlooks and what we saw in the most recent fiscal year. So I'll now take that and look at the 3 agency forecasts for many of our major taxes. Just a technical note before we get started on this section. We'll show some slides on a baseline basis. So those baseline slides, like this first one for income tax, take out the tax policy changes and just look at the baseline growth in the underlying tax base. And we do have a number of policy changes, as everyone knows. Over the last year, there have been a number of tax policy changes. We talked about those a lot in the last consensus, but just to highlight, the big ones, most of the largest ones impact individual income tax. We had the rate trigger reduction of the rate that'll impact fiscal year 23 and 24 that will lower revenue by about $600 million. We had the $400 million expansion of the working families tax credit or earned income tax credit that David mentioned, which will continue throughout the forecast horizon. And then the changes to the taxation of retirement income that by the time it's fully phased in fiscal year 2027 will reduce income tax by about $500 million. So the chart here that we want to start with is income tax, and we're going to spend the next 3 or 4 slides looking at income tax for a couple reasons. One, it's a really important part of our overall general fund. In all of our forecasts, individual income tax accounts for over half of our general fund revenue. And second, this is the one that has the most difference between our outlooks. As many things return to normal, our forecasts are also returning to normal, so our outlooks are a little closer than they have been in the last few forecasts. But the one big difference, or bigger difference, is on individual income tax, where we do have slight differences in outlook. So we wanted to highlight these for you. So turning first to this baseline chart David has on the screen, we saw baseline individual income tax growth
drop by just under 5% in 2023. This was expected with modest withholding growth and some timing differences because of FTE and some of the slower payments and higher refunds that we saw in 23. We expect that to more or less continue through 2024. All of us are very close in our outlooks for 2024 withholding. On a baseline level, we're expecting withholding to increase by about 2.9%, ranging up to 3.3. So the admin number is 2.9, Senate fiscal is at the high end in 3.3, and House fiscal is right in the middle of our withholding forecast. So you can see that on the chart here, we're showing you total, and that's due to it being dragged down by dropping payments, increasing refunds for many of the factors that David outlined. We forecast that to increase in 2025 as things return more to normal and we start to see quarterlies and annuals on a more normal basis. The next slide highlights our outlook for individual income tax refunds. This is one that we all see remaining at high levels. David did a great job of outlining the changes we've seen over the last couple of years. All of our forecasts are about $1 billion over the level that we saw in 2019. So we're all forecasting that those will stay at elevated levels. The growth rates around that is a little bit different. Two of the three agencies have forecasted another increase in 2024. SFA is a little more optimistic on that and has refunds falling a bit. So this is probably one thing that drives the difference in some of the general fund and overall outlook that we're showing. Another change is the income tax quarterlies and annuals. This is driven largely by business profits and non-wage portions of the income tax collection. We expect that that will grow, modestly over the forecast horizon, in varying levels, and that's what's driving some of the differences in our net income tax estimates. So we'll put all those pieces together in the next slide. With just a note here, this is now net income tax estimates, so dollars in the door, and we're all forecasting net increases even after layering on all of the policy changes that we've had. And we expect those policy changes to reduce net income tax revenue ranging from about $700 to $800 million in each of these upcoming years. So next we'll turn to sales and use tax. Our sales and use tax has been quite volatile over the last few years. There are three main factors that drive this. The level of consumption from consumers in Michigan, the shifts in consumption from non-tax to tax, and then the third is overall inflation. And through the pandemic and the recovery at different times, we've seen all of those shift with different speed and magnitude. We are expecting those all to somewhat return more to trend, and we're expecting that this will be a bit more of a steady state forecast moving forward. We have, going out to 2026, there's about a $400 million gap between the lowest and the highest. That may seem like a lot, but in recent forecast conferences, we've been over $1 billion difference going out to the last year in the forecast horizon. So just for perspective, the low in 2026 is House Fiscal Agency. They're forecasting a compound annual growth rate of about 0.7% out to 2026. The highest is Senate Fiscal Agency, and they're forecasting about 1.7% growth on average through those years. So a couple takeaways here. All of us are forecasting sales and use tax growth that is slower than our inflation forecasts. So by default, that means that those other two factors that impact the growth rate, both the level of consumption and the shifting consumption, we're all assuming are also coming back to normal a little bit, that consumers will be a little more constrained because of, the shifting cash balances that they have in reserve coming out of the pandemic, and then also a slight shift back to non-tax versus tax spending on the consumer side. The slide David has here shows our business taxes. So sometimes we look at this in the consensus forecast as one big bucket, but there are actually two taxes that I want to draw out here. So we have the corporate income tax and the Michigan business tax. As almost everybody knows, we have the Michigan business tax that was repealed beginning in 2012. However, we still have about 130 filers of that tax, and we are paying out, and we estimate that we will pay out about $500 million per year in credits to that tax throughout the forecast horizon. So if you add that $500 million per year back to this, that gives you the other piece of the puzzle, which is corporate income tax. So corporate income tax has been very strong. We're all forecasting that corporate income tax will be over $2 billion in collections for the next 3 years. This is the first time we've all agreed that it's going to stay above $2 billion. So we hope that trend continues. We're forecasting that it stays at that level. It wasn't that long ago that we were getting close to $1 billion in corporate income tax, and now it looks like the trajectory is that tax will stay around the $2 billion mark. The last major tax we want to talk about is the state education tax. This is the $6 million statewide property tax. Growth here is driven mainly by growth in assessments. Since there aren't tax policy changes or rate changes, this is the simplest one to talk about in terms of what's going on. What's driving this is really the real estate market, as well as the growth in property tax assessments, which is capped under Proposal A at either 5% or whatever inflation is calculated to be that year. The last 2 years, we have hit the inflation rate multiplier cap of 5%. So in 23 and 24, for those tax years, we've hit the 5% cap. We expect that will not continue with the slowing inflation forecast that we have. But the tax will continue to see modest growth. Over the next year, I think Senate Fiscal is the most pessimistic with a 4% growth, and HFA is the most optimistic with a 6% growth. So still a pretty tight band there of solid growth. With that, I'll turn it over to Ben.
Thank you, Eric. The next couple of slides will take the revenue components that Eric just spoke about and put them into our major funds. I will then discuss the statutorily required calculations we do as part of the conference and finish with some risks to our revenue forecast. So here on the slide, starting with net general fund, general purpose, as Eric and David outlined earlier, the uncertainty and the agency forecast differences with respect to the income tax components, mainly quarterlies, annuals, and refunds, and to a slightly smaller extent, non-tax revenues, tells the story of our differences in each of these fiscal years. To begin, we all forecast a decline, albeit a modest one, in fiscal year 24 general fund revenue. The House and Senate fiscal agencies were close at about 0.7% and 0.8% declines respectively, while the administration was a little more pessimistic, forecasting a drop of 2.5%. Moving into fiscal year 25 and 26, we all project increases. In fiscal year 25, the increases are between 2.4% and 4.2%, with HFA being the weakest and the administration being the strongest. And for fiscal year 26, the increases are a bit stronger, ranging from 4.5% to 5%, with HFA again the weakest and the administration at the high end. I will note, as was talked about, that one of the main reasons for the stronger overall net growth is the expiration of about $550 million in CIT earmarking for SOAR and the Revitalization and Placemaking Fund. So on a dollar basis, the largest divergence is in fiscal year '24, with the difference between HFA on the high side and the administration on the low side of about $250 million, and that gap represents only about 1.5% of overall GF revenue. And in '25, that amount is about $150 million, and in '26, it's about $200 million. So considering the size of the general fund, all of our forecasts were in a relatively narrow band there. And the last thing I will note, that while we've come down from historic highs recently seen in the last couple of years, much of that decline in net GF revenue is due to recent tax changes and CIT earmarking. These GF amounts still represent relatively strong collections historically on a nominal basis. Moving on to the school aid fund, net school aid fund. As you can see in the chart, the forecasts for school aid are in an even tighter band. There's no year in the forecast window in which we deviated by more than $100 million. I think me set off to the side here sort of indicates the fiscal year '25 forecast, because HFA was about $40 million below the administration and SFA, who I think were off by about $1 million. Now that doesn't mean we all got there in the exact same way, but as was noted in Eric's portion on the individual revenue streams, we were not highly divergent on the main school aid and main school aid fund components, mainly sales tax and set. All of the agencies forecast net growth throughout the forecast. In fiscal year '24, those increases range from 0.2% for the administration to 0.7% for the House Fiscal Agency. In fiscal year '25, those increases range from 1.6% for HFA to 2.3% for the administration. And in fiscal year '26, the increases range from 1.7% to 2.2%, or 1.7% for SFA and 2.2% for the administration. Moving on to slide 20. The top half of this slide here just shows you the specific amounts for each year and for each agency that was represented in the prior two slides, so I'm not going to read through this portion. You can read that for yourselves to see those specific numbers. The bottom half of this slide shows you what the changes from the most recent consensus, in this case the May 23 conference. As this table sort of presents an update or a check-in to our prior forecasts, I will say that the lack of a comma in those numbers down below is sort of a welcome revenue forecasting reprieve, considering the significant revisions we've had in the last few conferences. While I noted a couple slides earlier that all agencies forecasted a slight decline in general fund revenue, in fiscal year '24, all three agencies revised the May estimates upward by between $181 million and $434 million. All agencies also revised the fiscal year '24 school aid fund revenues upward, but the revisions were smaller in a slightly tighter range. On a combined GF and SAF basis, HFA had the strongest upward revision of about $539 million, and the administration had the weakest at just shy of $200 million. That said, these represent small differences considering combined GF and SAF revenues total over $31 billion. The differences are narrower, but positive and smaller for all agencies in '25, as that chart indicates. One last thing I would note, and then in fiscal year '26, this conference includes the first estimate of fiscal year '26 revenues, hence the lack of a revision there. Moving on to the next slide. This represents a calculation for the Budget Stabilization Fund pay-in and payouts. This is a statutorily required calculation that suggests when there should be a pay-in or payout from the Budget Stabilization Fund. This is based on inflation-adjusted personal income growth after subtracting transfer payments. Basically, if growth is greater than 2%, then any of the excess over the 2% multiplied by GF revenue suggests what the pay-in should be. If growth rate is negative, that would signify a payout. There is no calculated payout amount like the pay-in amount. Rather, statute states that if growth is negative, you can appropriate up to 25% of the prior year BSF balance. And as we always do, as we always mention, and is in bold at the top of that slide, I will emphasize that the calculation suggests a pay-in or payout. There would still need to be an appropriation by the legislature. I will also note that there can be an appropriation even if the calculation doesn't suggest one, as has happened in the most recent couple fiscal years. Right now, none of our forecasts suggest a pay-in during fiscal year '24 and '25. However, in '26, the pay-ins range between 0 and $54 million. As for payouts, none of the agency forecasts suggest a payout over the forecast horizon. The last statutorily required calculation we do is the constitutional revenue limit. This limits revenue to 9.49% of personal income. The chart before you shows agency averages there in the dark blue. As a general guide, when state revenue from all state sources, not just general fund and SAF, grows slower than personal income, we fall further below the revenue limit. And when the reverse is true, meaning revenues grow faster than personal income, the gap would shrink. Looking at the chart, you can see that the record revenue growth during the pandemic did close the gap in fiscal years 21 and 22. Stronger personal income growth coupled with the declines from the record revenue highs and slower growth in those out years has us moving further away from the revenue limit to what would be nominal highs. Moving to slide 23, as with any economic forecast, there are risks. I would note these can be both upside and downside risks. RSQE and Leslie took you through some of the macroeconomic risks in their forecast, and I would say we all feel those largely overlap with what we see as the biggest macro risks. This slide highlights some of the major risks to Michigan tax revenue. Starting at the top there, while we forecast modest growth for GDP and personal income and subsiding inflationary pressures on the macroeconomic side, coupled with moderate growth to income and consumption tax revenues, we still hold consumption patterns working their way to a new normal and elevated inflation levels remaining sticky as a risk to our forecast. Next, the Tax Cut and Jobs Act has provisions that will expire at the beginning of 2026, which is now within our forecast window. So without any action by Congress, the expiration of certain provisions like the capped SALT deduction and provisions related to corporate taxes would have a direct impact on Michigan in that year, mainly around the continuation of the flow-through entity tax and CIT revenues. The next item listed there is a revenue and accrual process and standards about what needs to happen with this process. Does provide some uncertainty to our forecasts. There have been issues in the past about the timing of mega credits and some misclassifications of sales and use tax requiring us to make adjustments mid-year. Recent tax changes have added to that uncertainty around timing and volatility, and there are additional changes under consideration that could have significant impacts in any given year. I would note, sometimes these issues arise later in the budget year, which makes this impact difficult to adjust for oftentimes. And the last risk up there on the slide involves economic development incentives under the Transformational Brownfield Program and the Good Jobs for Michigan program. While we've started to try to account for these in our forecast and are aware of current outstanding and potential amounts, they still present a timing issue because of the uncertainty around when and how much is claimed in any given fiscal year. So with that, I think we'll take questions.
Thank you all. You all do a really nice job of laying it all out for us, easy for us to understand, and we appreciate that. Questions?
I just echo the appreciation for your work together. It's remarkable how close numbers came in, and also I wish there was a venue for meteorologists to have the same accountability about their predictions and where things ended up. Thank you.
Sure.
Just a comment, I completely agree. It really, the last two forecasts have been extraordinary, and Jim, thank you again for your contribution to those as well, and getting us on a path that provides nice, stable revenue projections and a good foundation for the budget process, so much appreciated. And, I found kind of interesting, all three of you made comments about in areas where your forecast really diverged, it was less to do kind of with your usual issues of, disagreeing on economic fundamentals and more to do with, accounting changes or, kind of nuances in our tax structure, especially as we're taking into account new tax types. And certainly, as you all think about that and what that means for your forecast and, being able to, work together, perhaps thinking partners and how we can, perhaps recommend some structural changes to help improve the forecasting process. I certainly would be open to that. So thank you in advance for your contributions.
Representative Leitner has a question.
Thank you. I just kind of want to go back to the part on interest early in your slides, and, you said a lot of it was from lapses, obviously work projects, stuff like that. So I'm just curious, because I forgot to ask this the other day, how long you anticipate that money sitting there? Because I know that obviously some are work projects, but we have work projects that have gone on and on and on, and nothing's been done, but the money's been sitting there and appropriated for years since I've been here. So I'm just curious if you have a forecast as to when that money's gonna be spent down, and then the decrease or increase, as more work projects come in, to that interest income, because it was a lot. I mean, it was, I think, an unusually large amount of money.
Yes, it certainly was. And work projects do play into that, but also, even once agencies have that money obligated through an encumbrance, sometimes it takes time for those funds to be spent down. So we are estimating that that will begin to, dry up over the next 3 years, not get back to normal, and we expect that we'll continue to have interest earnings. I think between the three agencies, we're all expecting that to be around the $300 million range next year, and then dropping at the end to about $100 million of earnings.
Is that 100 million number that, like, you said normal? Is that like what's considered normal?
That would still be elevated from what we've seen over the last decade. But there are two factors there. One, the state's cash position has changed quite a bit, and then also interest rates are just that much higher. So I don't know if that.
Thank you.
Thanks.
Eric, could you speak to the impact of the one-time federal dollars that the state brought in, that how that plays into the one-time interest too?
Yeah, absolutely. So under the American Rescue Plan Act, the state was able to capture additional interest earnings on that money for general fund purposes, and that accounted for about 200 million of this 600. So that specifically is a big piece of that, and under the federal rules, agencies have to have that obligated by the end of 2024 and fully expended out the door by 26.
Thank you, appreciate that. We will now move on to our K-12 presentation on pupils and memberships and foundation allowances. We have Noel Benson from House Fiscal, Beth Bullion from the State Budget Office, and Ryan Bergen from Senate Fiscal, who will be on Zoom if we need him for questions there. So when you're ready, Noel, you're going to start us off?
Good morning. Thank you for having us today. We are here to discuss the estimated pupil memberships for fiscal years 24, 25, and 26. What you're going to see generally is a continuation of the trends over the last few years. We are projecting overall pupil membership declines, largely due to demographic changes, and the bulk of those declines will be experienced by local school districts, while we are projecting public school academies to have slight year-over-year increases. Looking specifically at FY24, based on the fall pupil count data, we have revised our estimate quite a bit since May. We are now projecting a total pupil membership of 1,391,700 pupils, which is a decline of about 7,500. This is 1,240,000 in local school districts, which is a decline of 8,700, and 151,700 total pupils in public school academies, which is an increase from FY23 of about 1,200. Looking ahead to FY25, we're projecting a total decline of about 5,800 pupils for a total of 1,385,900. For local school districts, this is 1,233,500 pupils, or a decline of about 6,500, and 152,400 pupils for public school academies, or an increase of about 700. Finally, looking at FY26, we're looking at a total of 1,379,600 pupils, or a decline of about 6,300, with 1,226,500 in local districts, which is a decline of 7,000, and 153,100 pupils in public school academies, once again an increase of about 700 pupils. Looking at the FY25 non-public dual enrollment cost in the Treasury budget, we're projecting no change there, so that will remain at $3 million. And based on these revised estimates, the FY25 pupil membership adjustment factor is now 1.0042, and the FY26 pupil membership adjustment factor is 1.0046. With that, we are happy to take any questions you may have.
Questions? Catherine?
Thank you. So am I reading this right, that when you estimated pupils for this year, last May, that you're only 1,900 pupils off from now, that the number of pupils that came in
Yes.
were only 1,900 off from, that's also really good, remarkable. So can you just comment a little bit then, do you feel, I know that there were, you know, when the pandemic hit, it changed, you know, pupil attendance patterns, and there was some it was hard to predict the years after that, you know, the pupils coming back in. Do you feel then that we're kind of back to a stable place of, that the pupils who were still not part of the system have kind of come back again, based in our, at least according to forecasting models?
Right. So prior to the pandemic, we were seeing decreases of about 10,000 or more pupils per year. And so over the last few years, we do think that we've seen some of that coming back, and population decline has slowed a little bit since then. And so the last few years have remained fairly stagnant, it looks like, in pupil decline, but it's hard to say. Beth, do you have anything you would like to add to that?
No, I think I absolutely agree. I mean, we were seeing pretty significant year-to-year declines, and so that has softened somewhat. So, you know, we do feel like we probably have set a new trend line, but we are a little lighter in terms of the decline, year-over-year decline. We're still seeing, obviously, still seeing some declining birth rates that are impacting us as well. So, yep.
And your membership definition is back to the 90-10,
Yes.
Yes.
to the pre-pandemic.
Yes, it is.
Right, that's fantastic. With that, can I have a motion to accept these?
So moved.
Second. All in favor, say aye.
Aye.
Those no, nay. And we have adopted those, and we thank you very much. We appreciate all your hard work on that, too. And
Thank
thanks,
you.
Ryan, I know you're there, too. And with that, I think we'll take a quick recess and come back, and hopefully pretty quick here, since everything seems to be pretty good. All right, we are now back. We have Jim Stansel to give us the recommended forecast.
Thank you. When Ben suggested that I do this as kind of my swan song, the first thought that kind of ran through my mind was from The Godfather. Is, just when I thought I was out, they pulled me back in again. So, as we do typically, I'm not going to go through the economics numbers, but you can see those, and they pretty much fall in line with what Eric and David had talked about. And I'm just going to go across the top and go through the GF and then do the school aid and go through those real briefly. We're looking at about an 8.2% decline in a preliminary final for 23 for GF revenue. That's for 24, we're looking at about 2.5% decline, but it's still an upward revision from May of $359.1 million. So again, as had been noted, even though we had a decline in revenue, we're still better off than we were in May, or at least that's our projection. For 25, it's about a 3.1% increase in GF revenue, and that's a little bit over a $100 million increase from May. And if you carry that out a little bit, we're into 26, we're looking at 4.9%. On the school aid side, the decline in FY23 is only projected to be about 0.1%. It actually becomes a 0.5% growth in 24, but with a revision from May of just under $60 million. We're looking at 2% growth in 25 and a revision from May of 41.1 million. Obviously, as you can tell, the SAF adjustments for May are much smaller than GF because, again, the major components in school aid fund revenue are sales tax and SET and BRET and things that were not as volatile because of the income tax components. And then finally, a 2.2% increase in 26 is what we're projecting. Dropping down, straight down to the long-term trend, we're looking at 2.5% and 3.1% growth rates for 27 and 28. And obviously, I won't be here for you to laugh at me if those don't play out. And then for school aid, 2.7 and 2.6 in 27 and 28. Moving over to the left and looking at the revenue limit calculations, which Ben talked about as part of his presentation, we're projecting that we'll be just shy of $12 billion below the revenue limit in 23. That increases to about 12.3 million or $3 billion in 24, 13.6 in 25, and 14.2 in 26. When you look at the BSF calculations, we would not anticipate any payouts or pay-ins over that time period. Building off of the pupil adjustment factor, you can see the revenue adjustment calculations of 1.077 and 1.0235 for our economics purposes, and that gives you an overall school aid index of about 1.022 for 25 and 1.082. Yeah. So roughly 2+% increases, approaching 3% in 26 in the foundation allowance is what would be projected. Finally, as far as the income tax rate trigger is concerned, as we talked about last January at this time, we don't have the required information necessary to make those calculations, and so we will revisit that when the act is published. And with that, I will take any questions.
Thanks, Jim. Any questions? Can I have a motion to adopt the projections?
So moved.
Support.
All in favor, say aye.
Aye.
Those against, nay? No? The revenue forecast has been adopted, and we thank you. I'd like to thank all of the staff again, from House Fiscal, Senate Fiscal, the administration, the Budget Office, for all their hard work over the last couple of weeks. You know, this takes a lot to put that together. I'd also like to thank all of the tech people behind the scenes, our administrative assistants. The amount of work they do that you all don't see is phenomenal and makes this conference happen pretty smoothly. But I'd also like to take a minute here and thank Jim Stansel. Jim's retiring in March after 25 years at the House Fiscal Agency. He's been my mentor, my colleague, my confidant. There's not a question I can ask Jim that I can't get an answer from. You know, get an answer from. Jim really is, he's a teacher that comes across, at least to us at the fiscal agency. He just puts that hat on and he tells us, this is what's going on, this is how you think about it, and then, you know, 2 days later I'll go back, what would you say to me again, you know, type thing. But Jim is just, you know, one of those people that we're gonna miss at the agency. He's been instrumental here at the Revenue Conference for the last 25 years, so that means at least 50 revenue conferences, probably more than that. There's, you know, how many economic revenue forecasts, we'll throw in a few Purdue forecasts in there too. But he's done it with professionalism and some humor in there, and you know, that's fantastic for us. We're gonna miss you. It's well-deserved. We thank you for your service there and for just being a great colleague to me too. Any other comments?
I just also want to thank you, Joe. I mean, I have not been as many times up here as you, but certainly the 25 years have been an extraordinary 25 years. I mean, who would have thought you would have had a great recession and a pandemic, and you know, your help steering the ship for the state of Michigan is incredibly appreciated. So thank you for your service.
I might point out that Michigan started to go downhill just about the time I was hired, so.
Oh, it was you. Okay.
I don't know if correlation, but the causation are the same.
And with that, this January Revenue Conference is adjourned. I don't think there's snow yet, but if there is, drive safe, please.